Good morning. Good morning. Good morning. It is a good morning. So happy Monday to y'all. So, as you can tell, I've got a little bit of an itch. I got to take care of some desire to jawbone a little bit. So I figured I'd lend my time since it was made available for the next couple days. Today, tomorrow, and Wednesday, we will be live streaming for 4 hours. So 8 a.m. to noon. Today will be the introduction, kind of like a relaxed discussion over tape reading. I'm going to talk about certain points that are going to be salient tomorrow and Wednesday. My goal is to kind of like present a nuts to bolts approach to bias and the lack thereof, because that is the number one question I get predominantly in either emails, messages through TradingView, or on comments on Twitter, comments on my videos. Michael, could you just please teach me how to determine the bias? Okay, and we're going to talk about several forms of bias, when to look at one and when not to consider it so much. So it's kind of like the audio book version of the chapter that will be in my book. And yes, they're on their way. Okay, I'm not in control of when they get disseminated, but they're on their way. But this is going to like be 3 days worth or 12 hours worth of audio commentary directly from me. And it'll be used over the scope of real live price action, which is not something that is communicated effectively, in my opinion, when you're doing with a book. Okay, because invariably, if you buy a book and you look at it, whether it be my books or anyone else's books, and I can testify that this is true for me as well. When you look at a static image or static images, and a concept is being promoted or suggested as being viable, it's hard to garner the confidence in it when you're just looking at something that's already happened. Okay, so that's the reason why I like to go over live price action with the smallest of time frames, because it proves, number one, efficiency. It proves the understanding that the logic is really there. It's not contrived. It's not a conjecture. It's something that really is there. It can be measured in terms of a daily experience that what you see me do today, tomorrow, and on Wednesday. This is what you should be doing regardless of where you are in your prowess, skill set, experience, whatever. Before I start, okay, because I kind of want to go right into some of the things, but I have to have a little bit of a preamble here. It's important to know, if you cannot grasp from your analysis, and I'm going to show you what I do every single day, okay? I'm going to talk about what I do on the weekends, but then I'm going to show you what it is I'm looking at before 8:30, and then what I'm looking for, or what I'm anticipating between 8:30 and 9:30 when the equities market opens up, what things I'm considering, how much weight or emphasis do I place on one thing or a few things and not so much on others. Okay, so it kind of like gives you the practical, this is what I do, this is how I determine what it is I'm expecting in terms of price action, whether there's a bias that should be considered for that trading day or that session or that week, or should I trade without a bias. So I'm going to teach you how to do both of those this week. Okay, I can't promise that I'm going to cover everything that's going to scratch every itch that you have about it, but that's okay, because I will leave a post Wednesday evening on my community tab on my YouTube channel saying, if you have something that it didn't address or answer, I guess, sufficiently enough for you, it's kind of like a suggestion box for you to leave a comment. Now, I see every comment. You see your own comment, but I see every comment that comes. So if it's something that you want me to touch on as a later discussion or whatever, if we do a live tape reading session again beyond this week, which I'm certain we will, I'll kind of like bring that into the conversation and kind of address it. Okay, that's usually how I do things. But the impatient folks, they want everything right now because they have a TikTok mentality. Give it to me in 30 seconds or it ain't worth listening to. And if that's what your mindset is, it's probably not going to be good for you. So this is for people that really want to learn how to do this independently, not have to watch other YouTubers, me included, not to buy courses, not to buy books, not to buy any of those things. So I want you to know, while my books are coming, you don't need to buy them. Okay. In fact, you probably shouldn't buy them, but it's for people to know that all these concepts were authored by me. And that's the only reason why I'm doing it. These 3 days are going to be the better version of what I'm going to say in the chapter about bias, because you're going to see it. You're going to see it explained. You're going to see me outline what it is that's important, and then how you can begin the study of learning how to do it on your own. But also, I'm going to untether the necessity for you to have a bias. Okay. In the beginning, I think it's important for a trader that has next to no experience, or if you're someone that has been hit and miss with your results. Sometimes you can get lucky and get a profitable week or a profitable month. It may be a short span of time that you are able to trade correctly and therefore see profits increase in your equity. But then something happens and you unravel and you lose, and it goes into a tailspin and you lose all your progress. I'll address a lot of that on Wednesday, and I'll also cover on Wednesday how to hold on to trades and trust what it is I've taught today and on Tuesday, and what I will close with on Wednesday. So it'll help you understand why you shouldn't be afraid, okay, and how to overcome that, and how to manage all those things using price action and not having a whole lot of necessity on, I have to know what the high of the day is. I have to know what the low of the day is. You don't need to know that. Okay. So first and foremost, let's get into it. I mean, just post one more time. I want you to see the risk disclaimer, because some of you just showed up here a little bit late. All right, so I had to toss that in there once more. Because I know some of y'all like, okay, I'm going to get in here and trade on everything he says today. So when we're determining, or when I'm specifically working on a bias, I like to build that idea ahead of the Sunday opening. Okay, so whether it be Friday evening, or whether it be Saturday during the day, or early Sunday morning, whenever my free time is available, because my wife and family kind of like dictate everything now. So I have to find time for this stuff on the weekend. But whatever time it is, it's usually about 30 minutes. It takes me about 30 minutes to go through all the major markets. And the first and foremost thing I'd like to look at is where we are in terms of seasonal tendencies. Okay. So in my opinion, seasonal tendencies are best determined by Steve Moore. Okay. Steve, this is not a paid advertisement. I've said this in my mentorship videos as well. Steve Moore probably heard about me because I've been repping his stuff since 1995, and I have a little bit larger audience now. So when I say this is a resource I believe in, this is a resource that I use, he does not give me anything. I don't get a kickback. I didn't ask for a kickback. I have no affiliation with any company. I don't have any kind of affiliate links. I don't do any of that stuff. So when I share my opinion, it's raw, it's real, and I don't care if the people like or don't like it. It's something that either I use or I don't have a use for it. Okay. But one of the best tools that has served me well in my analysis for over 32 years coming November. This tool, this resource of understanding the roadmap of what usually, not always, but usually happens in the marketplace is a seasonal tendency. Now, Larry Williams was the first one that ever wrote a book about it and put it in publication. And I think, if I'm correct in my title, no, not my title, Short-Thing Commodity Trading Seasonal Tendency, something to that effect. It's a little misleading, I think, in terms of a title, but everybody does clickbait titles on their videos now, so he was like using clickbait back then. But some of those seasonal tendencies were like bangers, like real easy, real simple stuff. But some of those markets don't even trade anymore. For instance, like pork bellies and egg futures. Okay, but eventually, over time, there was individuals like Jake Bernstein. He had a big run with seasonal tendencies, and I've never subscribed to his stuff, not to be disrespectful to him, but Larry had a lot of affinity for him, and it may be just a partnership that they had at that time, or maybe it was a real good friendship, maybe it still is, I don't know. But I didn't have any confidence in his work with seasonal tendencies. And that might be met with opposition for people that, like me, as a dinosaur, have been here for a long time dealing with these markets. Maybe you had success with it. Maybe you learned something from that. And that's fine. I'm not trying to disparage anyone to not look at his stuff, but you're watching my video and you're watching my live stream. So you're kind of like here to get my opinion or what my take is on something. My opinion, the pentacle of the seasonal tendency market, the person that has the best product is Steve Moore. And you can do a search on his website, and he doesn't ask a whole lot in terms of what it costs to get the information. But these things, these graphs, he'll show multi-year seasonal tendencies. And I used one of them the 8th of this month when we did our live stream. I explained to you, and I'll kind of like go back over what it was I was referring to. But you can go back and look at the April 8th live stream where I explained how we're going to be seeing several hundred handles lower in the stock indices. And you see it in your chart. Or if you haven't noticed it, you might want to look at it. But seasonal tendencies are the first thing that I consider. And I usually refer to them on a weekly basis. I want to see where we're at. And what I'm looking for, and you're probably like asking, why don't I show a seasonal tendency chart? Because I want you to go look at his free samples. Okay, look at a free sample, and that's what he offers. And there's a lot more that he offers, but I don't use that. I just look at his seasonal tendency over the view of the multi-year overlay. So what he'll do is he'll compare, say, 15 years of what price has done for any given market, and then he'll compare it with a longer sample set. So what I like to look for is where there are two sample sets of time where he's measured the fluctuation of price. And if there's a period throughout the calendar year where both of those measurements, and it kind of looks like two moving averages that are like moving along on this graph. And I know some of you are mad right now, like, well, I wish you would just show a chart. I don't want to do that. I want you to investigate it yourself. And it's free to go look at his samples. But I show you a lot of those in the mentorship videos. And I'm repping him then. I'm telling you, go use his resources. And because I don't get paid for it, and because I actually use it, I've actually made real money with it, lots of real money. It's not something that is a conjecture. Like I said, it's not something that is opinion. If you know that where you live and the weather patterns suggest that something may or may not happen during the weather cycle, like for instance, we're in May in this week. Coming this week, we'll be entering the month of May. When we get into the month of July, where I live in Maryland, the east coast of US, it's highly unlikely that we're going to see snow or a blizzard in July. So that's a seasonal tendency. That's a pretty strong seasonal tendency. Now, how about right now? Could it snow technically in April? It could, and it has. We've had blizzards in April in Maryland. So that would be an example of a seasonal tendency where maybe one period of time where he's measured the seasonal tendencies, it may have gone up for a few weeks. And in a longer term view of what a market has done seasonally, it may have done the opposite. I don't like to trade those. I like to find, and it's not a lot of them that occurs. So there's like this little sweet spot in the year. I look for the best period of time in the spring, and I look for the best period of time in the fall. Because what I've done is I've cherry picked the very best of the best times to trade. Because the spring season and the fall season, that's your turning points on the higher time frame, monthly and weekly and daily charts. Don't take my word for that. And it probably went right over your head, but that's the part where you're supposed to be writing down your notes. Okay? Because if you're going to be a long-term position trader, or you want to have a long-term bias, those turning points, they're like the bookends. Okay? They're the parameters for the big, huge runs every single calendar year are usually boxed in by the extreme high or low of those two time periods. Okay, so my emphasis is focusing on markets that I typically trade, which is index futures, bond futures, and I moved away from Forex, but you can trade currency futures. Like if you don't want to be in Forex anymore, you can trade currency futures. And it's it's the same thing, but there's a slight little advantage to trading index futures, because they're a little bit more liquid and they have a whole lot more smaller intraday setups. And we'll talk about that real time today, where I'll touch on not having to have a bias and how can you grind out an income, okay, without a bias. Because if I had to be asked what my opinion was of the audience listening today, or that audience that will watch this video or the series of videos that we're doing, the common denominator would be is you're not either confident in knowing what the bias is. And what is bias? It's where you think the largest probability of movement is going to be. You're not trying to predict the closing price. You're not trying to predict the high or low of the day. It's distinct from what we're talking about today. You don't need to know those things. There's things to determine that, and I taught that in mentorship videos on this YouTube channel for free. You don't have to pay for it. You don't have to go to other YouTube channels that are trying to hawk my stuff and sell it. You're a fool if you buy that, okay, because it's here for free. If you can focus on the spring and fall session and anticipate directional runs that last for weeks to months, it's not always a straight shot from a spring high to a fall low, but predominantly it is. And again, that's the part where you're supposed to write that down. So what happens if you are in a market environment that's bearish? Wow, you really have a loaded deal, because in spring, what is spring? April, May, okay, April and May, there's this transition that'll send the markets lower and going down into the late summer weeks or months into September or October, and as late as the first week of November. But very rarely does it do its turning point in November. Usually you'll see the turn between the last week of August and the second week of October, and that's usually the low of the year. That's not 100% always happening, but that is how I look at the market. Every single year I go in with expecting that to unfold. And then what I do is I look at the details that the market's actually showing me day by day, intraday, week by week. How are we behaving? How are we anticipating these targets? Are they still probable? Are we still likely to trade lower with that mindset? Now, what happens when you're in a very strong bull market condition, like we've been for several years now? That means that the spring highs can tend to be quick and sudden initially, and then it can go consolidated a little bit and then slowly drift down. Or because now it's a presidential election year in the US, those spring highs down the fall lows don't tend to be as crisp or pristine in price. It's a little bit muddied, and sometimes it can be altogether rejected, and there's just a short-term drop in the spring months. And then when we get to mid-May or first week of June, we take off and we start going higher. And we don't even try to do anything going into the lower extremes for the summer months and or making a low in the fall. There will be likely a low that forms in the fall. Any environment, whether it be a bearish market or a bullish market, it's just a very strong tendency for the market to create very easy long positions, opportunities to see the market rally. It may be short-lived, but trading in September, October, and the first 2 weeks of November, being a long holder, looking for longs, that is like some of the easiest stuff you'll ever do as a trader. Like, it's like easy money, it's easy opportunity, it's easy. Everybody's stuff, if they've just filtered out how to be a buyer only during that period, chances are your probabilities will now shift in your favor if you hadn't been doing it. But the problem is everybody looks at the chart and they think trend is friend, but it's not in the end. So I like to look at those two extremes of the year. So that way we know now the highest form of determining bias, I gave it to you for the full year. How do we anticipate power 3, which is the accumulation, manipulation, distribution of price action on any given time frame? It's on every time frame. It's on second charts, 1-minute charts, 15-minute charts, all the way up to whatever time frame you want to create in TradingView. You can create your own unique, customized time frame, and that's one of the benefits of having a platform that's not one trick pony only. You can create your own time frames. If you want to look at an 18-minute chart, You can create that. It's a custom time frame that you can create. So, and we'll talk a little bit about that on Wednesday, how to go through and look inside price without the typical perspective that's usually seen. And even in my, like the early lessons and the elementary lessons that I have on my YouTube channel or have done in the past, where I look at specific canned or pre-selected time frames. I only did that because it's easy to teach a large group of people if we all start with the same baseline, and then we can obviously build upon that. But after looking at seasonal tendencies and looking for times when a market that I'm interested in trading has both the longer term and the intermediate term seasonal tendencies agreeing. And what does that mean? Steve Moore has the graphs that show over a calendar year the movement generalized of what the market will likely do any given time over that calendar year. I want both the long term and the intermediate term seasonal tendency to be moving in the same direction between one time of the year. It may begin at a specific month. It may begin halfway between the beginning and the end of a particular month. And I mentioned on April 8th in our live stream, I said, I'm anticipating the market to move lower. Several hundred handles, not 10 handles, not 25 handles, not 30 handles, not 50. I want to see hundreds of handles, okay? And now, just because we have a seasonal tendency there, that doesn't mean it's a green light go. Okay, it's Monday now. I've been waiting all weekend to trade. It doesn't mean to go out there and start doing something right away. You have to go in and anticipate price presenting these opportunities, and other things have to compound as a confirmation. What it is you're looking for is really there, and you're not just trying to force your will on it, because you can still fall victim to your own will if you force it, because the market doesn't really care too much about what you think or what I think. It's going to do what it's going to do, and it's our job as an analyst to get in sync with what it's likely to do. And that analyst aspect is not trading yet. Okay, you have to be able to see things for what it is, what it's likely to pan out, and then over a period of time doing it, months, if not at least a year. That's why I teach everybody that's learning from me should expect to invest a full year minimum, because you're not going to get the full picture. You won't even appreciate what I've already said right now, and you'll turn off the stream or you'll go do something else, and you'll fail because you haven't considered the very few things I've already covered here that are paramount. That's how I feel confident when I was going on Twitter and telling you minute by minute where the next candle was going to go and follow this and follow that, because it's based on those time periods where the seasonal tendency was in agreement, the market structure was in agreement. I understood the probable narrative, and we're going to talk a little bit about narrative tomorrow. The idea of how all this stuff blends together. It's real hard to be anxious when you have a firm grasp on all these components. It doesn't mean that you're going to be 100% accurate. It doesn't mean you're going to be without a losing trade. It doesn't mean that you won't have drawdown in your trade. It just means that you won't be shaken out of your trade. And if you do get stopped out, it won't change your approach to using this information. That's maturity. And it's hard to be mature in the beginning when you don't have any idea what it is you're supposed to be doing. You're jumping from one method to the next, one guru to the next, one video of mine or one video series, thinking one's going to be better than the other. There isn't any one better video. There isn't any one better series. It's a starting point, and then go through the content, because I always pull in all this stuff. Eventually, given enough time, you'll hear me talk about things I've talked about very infrequently, but still they're essential. But my assumptions is you've taken notes and you understand that component. So with seasonal tendencies aside, the next thing I look at is the economic calendar. So this is an example of it here. This is the Forex Factory calendar. And if you're a Forex trader, you would obviously have things toggled for those currencies. Right now, I only have it set up for US, and these are the settings here. I don't usually look at the yellow, which is a low impact news driver. I don't care too much about that. I want the orange, which is medium impact, and then the high impact. If you're a trader for Forex, you would toggle the pairs that you're interested in trading. You don't need to toggle all of them, okay? You don't want to dilute your attention. You want to keep everything focused. And once you have that, then you can look at your full week here. So you can see on Monday today, we have nothing really in terms of Forex Factory. There are some events that you can see on Econo Day. Okay, Econo Day is another calendar that is more equities specific, and it's, to me, if you really want to be a perfectionist, that's the calendar you want to look at. But in terms of teaching individuals that have a very low experience, or just coming into understanding the markets or being interested in them, this is a calendar that's very easy on the eye. It's easy to manage. It's easy to see, the big triggers for when the markets will likely see some kind of excitement. Okay, and that excitement is what we call manipulation. Many times during the times of these reports, like tomorrow we have 8:30 a.m., the employment cost index. I don't ever consider the data. I could care less about these data points, because these are just excuses for them to, and when I say them, it's those individuals that are in control of the marketplace. Just like out in Las Vegas, when you go to those casinos and they give you the free room, they comp you, free dinner, free events, magic show, comedian show. They'll give you all that stuff because they know if they can get you into the casino, given enough time, you're going to pay them. you're going to lose your money. So these are like scheduled events where you're going to have the opportunity to lay your money down and leave it there and go home without it. We call that a loss. Okay. But a newbie or a inexperienced trader, they see it as they got me, or that guru taught me something that doesn't work. When really what they're doing is, and you know this as truth, you see these big events, you hear other people talk about how there's going to be a lot of movement, and you think, I could make a lot of money. Yeah, you could. You could also blow your account on that one trade. Don't believe me? Try to trade CPI or PPI. It's gone. So when we're looking at this timing aspect, I'm anticipating some measure of manipulation. Okay, so what I like to do, and this helps build, kind of like introduce the idea of narrative building here. I like to look at what price has done right before these scheduled time events where the economic calendar will produce the data and present it to the public. Okay, individuals that are in better positions for information's sake, they have the ability, much like politicians today. Nobody wants to be a politician to turn things around, but they want to be a politician because they have advantage. They have information before the public gets it, and they can go and they can buy their stock options. And people that make $200,000 as senators, all of a sudden they're multimillionaires in a year or two, and there you go. So there's smart money that has the advantage of knowing what these drivers are going to be like real time. And it's not to say that these events and the data that is released at the time and or the initial move that occurs at the time that the report comes out, it doesn't mean that that's the right move. It doesn't mean that that's the move that's going to be sustained and it's going to keep moving in that direction. Many times, and this is really what I'm looking for, I'm looking for these opportunities where I have a seasonal tendency in mind, that I have a long-term macro directional bias. Because if you can trade in that right there will filter a lot of your losing setups out of your results, which is something that you should do a lot of work to try to do, versus I'm going to open up a chart on a 1 minute chart, because ICT students, we all trade 1 minute or less. And that's where smart money trades. Smart money does not trade on 1 minute charts. Okay. They don't do that. Smart money trades on monthly, weekly, and daily charts, because they can't move billions of dollars on a fluctuation on a 1 minute chart or a 15-second chart or a 30-second chart. But you're not trading the volume that they're trying to push into the marketplace. So you have the advantage, being a small fish in this big ocean, where you can go in and place a trade in very small, ultra short-term time frames and capitalize on that and make 10, 15% in a day. And over time that compounds. And then eventually you get to a trader size where you're doing reportable trades, where every commodity or every market has a reportable threshold. When you start trading a certain number of contracts, they have to be reported. You're counted in the COT then, the Commitment Traders Report. Your trades would eventually be a part of those numbers. But when you're not, you're still considered a small fry. Okay, and you can be trading lots and lots of contracts, but still be considered by definition in terms of commitment traders, still be a small trader, a small speculator. So I like to look for those periods right before the time of the economic report coming out, that I anticipate that economic report being a Judas swing. A Judas swing is a fake run. It's a price run that's quick, it's sudden, it's explosive. It runs directly into a pool of liquidity. That means above a high or relatively equal highs for buy side, or it reaches up into a fair value gap, which would be in many instances a SIBI, a sell side imbalance, buy side inefficiency. So a down close inefficiency. Those are the two things I'm looking for if I'm bearish. Now, how do I know which one's going to happen? How do you know, ICT, which one it's going to do? Well, if there's no inefficiency, what's it going to do? It's going to run for the high or a group of highs. It could be 3 clustered highs in relative same price area. I'm going to pick the highest one. And I'm going to see, does it want to reach there? If it reaches towards it but falls short of the highest one of the relative equal, or if there's like 3 of them there, if it doesn't run the highest one and it starts to drop, I don't trust that drop. That's usually many times a trap where they'll then pump it one more time, run that one, take the higher high out. Then the break in structure after that, when it moves lower, then I'll be all over that like white on rice, selling short. But that's given I'm in a seasonal tendency that's bearish. I have a weekly range that's likely to reach for something, and I'm going to cover that part today. But I want to give you these are the points that, imagine me trying to describe this in just text form in a book. It doesn't hit the same. And you won't even read that chapter. It'll just be like, well, I'm going to go to where the pictures are. And this is the stuff that filters out all of the majority of why losing traders lose so much, because they don't factor these types of things in. So what I'm saying is if I have a seasonal tendency that I'm bearish, then I have a expectation that the market's going to introduce volatility. And that's what this calendar does. It tells me, like a TV guide, when do the games come on? If you're a sports fan, I'm not. If you're a sports fan, how can you know when the next football game or the next basketball game or the next rugby team is going to play your this, that, and other thing? You go to your TV guide. Every platform that has programming, TV programming, will tell you what time, what channel, and what's happening then. That's what this does. It tells us when we can sit back and relax. Now, as a new trader, when you first started trading, you never even looked at this stuff. You're looking for patterns. You want to see a head and shoulders. You want to see a harmonic pattern. You want to see moving average crossovers. You want to see order blocks. And you want to see, fair value gaps and breakers. And you want to see all these other things out there. When they may exist in price, but because they exist in price alone without any context, that's why they will fail. But you'll walk away with an infancy in terms of experience, thinking that therefore you've proven that this stuff doesn't work, so therefore let me go find an indicator that's going to tell me how to do something. And then you'll discover that the indicator isn't telling you anything except for to trade at the wrong time. Buying when you think it's oversold, but it's in a bear market, so it's going to stay oversold. So that's why I opened up this lecture series with this, because this is the stuff that matters. This is the stuff that I had to learn by blowing lots of accounts as a 20-year-old. I didn't learn this lesson from books. I had to learn it from losing real money and going back and saying, okay, why did my trade lose in stunning fashion? I was long because in the beginning, that's all I ever wanted to do. I didn't trust being short. And I would get these big, huge drops against me, bang. And because I was trying to trade without a stop loss, it took all, if not majority of the trading account away from me. And it's demoralizing. It sucks and it's avoidable. All of that is absolutely avoidable. It doesn't feel like it, especially if it just happens to you, but it is avoidable. And you have to, number one, build in the permission for you as the speculator, the trader. Right now, if you consider yourself the student, you have to give yourself permission to be wrong. Because if you equate everything to right or wrong, you are going to struggle in this industry. You are going to struggle. You're going to be angry all the time. You're going to be scared. You're not going to trust your decisions. You're going to let everyone else around you influence you. And it's never going to be the good influence that's going to affect you. It's going to be the bad. And it seems plausible to you when you're in that state of mind. let's look at ICT's videos. Let's go look at somebody on social media. Look at so-and-so, he's selling a course. Look at so-and-so, he does live streams. Look at so-and-so. And what you're doing is you're trying to replace that uncomfortable state of mind and uncertainty and a lack of a plan or understanding of what it is that you're trying to do that should repeat more times than not. You're trying to replace that discomfort with distracting your attention with someone else doing something. Because in your mind, if they do it wrong and you follow them, you taking that loss, well, you've built in, well, it's their fault. They did it to me. And your subconscious retains that as you didn't do anything wrong. And that's a problem on all fronts. You shouldn't be asking anybody else what they think about the marketplace unless you're looking to fade them. And that's what I do. I look for the public in their live streams, in their chats. When I have a setup that is, I'm bearish, I'm in a seasonal tendency that's bearish, I have a market structure that's bearish, I have a market that is rallied up into a short-term premium, and I have a day when there's going to be a news driver that's going to be releasing with a high impact, which is always a red folder, or a medium impact, which is an orange folder. My focus is limited to that. So I'm picking. Think about it. You ever wonder why I was only going out there certain days on Twitter and say, this is the candle I'm watching on this 1 minute candle. I'm watching this. Go back and look at the calendar on those days. Look at the time. It's the same thing all the time. It's just like everybody else that wants to be a couch potato and they know what their favorite time and channel events are going to be. I know what I'm looking for that given week. So I want to see a manipulative price run, which is a Judas swing, something against what I expect to occur. An example would be if I'm bearish, seasonal tendencies bearish, the longer intermediate term are green in terms of Steve Moore's graphs, and that seasonal tendency is implying that we're likely to go lower. I want to see a news impact driver on a counter like this that has a red or orange folder at that given time. Now, ideally, what I want to see is this. I want to see right before 8:30, if I'm bearish, and I'm not saying that this is the case, I'm just giving you the nuts and bolts. If I'm bearish, I want to see right before 8:30, I want to see it drop down below a short-term low first. Why? Because that triggers individuals on a breakout short or knocks out the long holders that have have a sell stop right below a recent low. I want to see that happen before the news driver hits. Then I want to see at 8:30, I want to see it rally up. Now, again, someone's going to take this soundbite and place it on, say, he said this is tomorrow. I'm not calling tomorrow's price action. I'm giving you the procedure of how I go in and I look for very specific days, weeks, months to trade, because I'm not trading every day. Just because I can day trade doesn't mean I'm an everyday trader. And you shouldn't be either. And that flies in the face of everybody that sells courses right now, because they want to tell you it's an everyday occurrence. Not if you don't know what you're doing. That's a recipe for disaster. And it's a recipe to cultivate poor habits, bad habits. Okay, you don't want that. So the way I teach is I want to give you the best of the best, so that way it filters out all the opportunity, if not all, at least the majority, because you really never can. I can't reduce it to 100% unlikely that you're going to have a losing day. You're going to have a losing day. You're going to have a losing trade. It's going to happen. But you're going to see, if you apply this process, it filters out. And that's what you really want. But you don't understand that yet because you're brand new, or if you've never had any success in this. You already have a predisposition to. You're looking for any excuse to justify everybody is a fraud, everybody's a scammer, nobody makes money, and you just want to have the permission to say, I don't want to do this anymore, because you can't hack it. And there's nothing wrong with that. If that's how you feel, don't fight it. Just leave. Don't trade. You'll probably be better off not trading. But for the individuals that are just simply not going to take no for an answer, and you know that given enough time and effort and doing things correctly, you can be profitable at this. These lectures are for you. But if you have that first initial drop against the Judas swing that you anticipate, so in plain terms, you're bearish. You want to see it drop right before the high impact or news event that's medium or high impact. You want to see it drop to take the stops that you think is going in the right direction, but you're not taking that trade. Now, all of a sudden, light bulbs are popping off. Why doesn't ICT trade this here as a break-in market structure? Why didn't he trade that? Why did he wait for... I'm telling you right now. I'm telling you. Are you taking notes? Probably not. You're waiting for the charts to get on the screen. But this is the stuff that matters more. Because the price action, that's the last thing that's important. All of this is the most important thing. I could write a book or series of books just on this topic, and you won't read them, you won't like them, you'll leave bad reviews, but this is the heartbeat of why successful trades happen. No matter what you trade with, this is why your trades made money. That's this series. That's this whole live stream lecture today, tomorrow, and Wednesday. How to know why your trades work, because I'm going to tell you right now, it isn't working because of your indicators. It's not because of some kind of harmonic pattern. It's not because it's a down close candle right before the up move and it came right back down to it. That's not it. That's not it. There's many times where the market makes a run and drops down to a down close candle, and that ain't an order block. What makes it an order block is these factors have to be there. You see how fast all of these other guys out there that are trying to tell you what an order block is, it fades away real quick. It fades away because they don't have this. And I'm giving it to you all publicly so you all have it at the same time. You want to see the smallest little degree of movement dropping down to take out a short-term low. What that does, it trips traders short on a breakout because they think that news driver is going to make a big move and they want to get in. They're gambling. They place a sell stop to get short when it breaks out to the downside. You are waiting because you know that that's likely to happen. And when this does happen, and then you anticipate at 8:30 and minutes after that, it should be running north. It should be explosively running higher. That rips the face off of anyone that went short, generally John Q. Public. Now what happens is traders are trapped going long because they're trying to buy the breakout above a recent high. They're trapped net long, and smart money goes in at that moment and sells into that rally because that's exactly what they're waiting for. That's exactly what I'm waiting for. Now, you, as a inexperienced student, may listen to that and think, man, I don't think I can do that. You probably won't be able to for a while. But that's not a problem because you can go into model 2022, okay? Wait for a market structure shift again below the low that was right before the news event. When that low gets taken out, then you have a market structure shift. Oh, how do you know what low to pick that causes market structure shift? All these things have to be there because think about what the market's doing to what classification of trader. If you're anticipating lower prices and you're expecting some kind of manipulation to the upside initially, creating the high of the session or the high of the day, everything prior to that has to be used in concert with what you're anticipating. And when you know these things going into that event, and then you see them panning out, you can see, okay, well, I can see John Q. Public, he's sold short. Or the people that went long initially, they get stopped out with that drop down below a short-term low right before the news impact driver at 8:30 or whatever the time frame is. And then that rally up, after they get stopped out, if they're long, they're going to do what? They're going to chase it or do nothing. Most of the time, they're going to be nothing. They're just like a deer in headlights thing. I got stopped out. Now look, it ran without me. If they're smart, they won't buy it and chase it. But most of them won't do that. They'll be like, oh, I got to get my funded account passed. And they're going to chase it. And it's already ripped. But you are waiting for that run higher because that's exactly what you want, because it's done harm to two sides of the marketplace. It's trapped traders short right before the run at the news impact driver, then rips their face off and stops out anyone that's already short by running the higher high. You're not worrying about any of those things. These are all things that you anticipate seeing in price. Now, two things are happening right now. In the audience that's listening to this, Number one, there's a large degree of you that are thinking, show me what that looks like on a chart. I will. But conceptually, in your mind, these are the things that I do, why I pick certain days. This is what I'm going to call the market. This is what I'm going to call the market. This is what I'm anticipating. Everything's there. Why would I want to go out there and say, okay, I'm going to try to figure it out as I go today? That doesn't communicate probabilities. It doesn't communicate authorship. It doesn't communicate anything except for, well, I'm just going to see what happens. And that's usually what happens with majority of traders. They try things before they understand how to do it. And if they do succeed, they contribute that to skill, or I was born to do this. I'm a goat. There is a such thing as beginner's luck. I had that. But then I discovered I didn't have it and I had to learn how to trade. And it took years to do it. Many of you wouldn't like to be told on the first day of you trying to learn this. It's going to take you years to learn how to do this consistently. And some of you would hear that and say, well, I ain't got time for that. Let me go to TikTok and see who's telling me how to do something right now. And that right now thing is just the reason for you to go out there and lose money. So these are the nuts and bolts on how I start the framework for a bias. If those things all agree and we're on like a Monday or Tuesday or Wednesday of the week, oh man, you can't understand how comfortable it is to trade in those environments, because I have so many things in my favor that even if I'm trading the largest degree of leverage that I would have on my trades, which is usually about 4.5%, that's not to say that you should risk 4.5%. But my large scale size, when I feel confident in these environments that I'm describing here, I will trade as much as 4.5% per trade, per position. If I take a loss, in these instances, I will not reduce my risk and cut it in half, because everything still stays the same and I'm willing to take that. Well, what you're saying is you're willing to lose 9%. Yes. Because that 9% isn't going to cause me to go into a tailspin and then go, well, I'm willing to lose 18% now. I'm willing to lose 30% of my account today. That's not what I'm inviting. I'm saying that I have the parameters still there that, yeah, I may have had my stop loss in a position that was too thin for the given market volatility, or I was too overzealous about limiting the risk because I wanted to get to that 4.5% risk. If I get stopped out, I teach you, because you don't have the experience, you don't know what you're really looking for yet, and you don't have the continuity of relying on this information to see that it pans out more times than it fails. You don't have that. That has to be, collected over time. And all of you are going to require a different measure of time. But I have the probabilities that can shift me right back above that 4.5% drawdown. And then, because I'm holding for trades that are 50, 75, 100 handles or more, even though I've taught individuals to start with like 10 handles or 5 handles for S&P, just to give yourself something to work with and build a baseline on. That's not to be saying that should be your career, that's your model in its entirety. No. Is it a breadwinner? Absolutely. Can you buy groceries every month with that? Yeah, absolutely. Can you pay your mortgage with it? Absolutely. But on the same side of that coin, if you turn it over, I have plenty of reasons how I can blow my account, because there's a lot of 5-minute or 5-handle fluctuations intraday. And if you don't know what you're doing and you're just in there trying to throw darts because you want something to fall in your lap and give you an attaboy or attagirl pat on the shoulder, you got to be very careful not to take this as skill versus looking at the market like this, where you take all these factors and blend them together and only try to trade in those instances. And that means there's going to be days in the month, not one day, days in the month where you won't even be trading. But you're not going to feel any apprehension about staying on the sidelines, because you know, based on your experience level, you only want to be trading when everything's lined up. And even though there might be a big move that happens and you weren't there, that's not the last trading day. That's not the last opportunity for you. But as a new trader, you think that way. And that clouds your mind when it comes to things like bias. Because when I say bias, you assume I know every single trading day, every single trading session, high and low. I know the bias for every single session in advance. I don't, because these markets have an element of manipulation that you can't expect to have foreknowledge of. You don't know when the next bomb's going to drop. You don't know when some terrorist attack is going to happen. You don't know when some major leader is going to have a dismissal where he's taken out of position. All these things are unknowns. So no one has the position of authority where everything is understood beforehand. And I'm not claiming that. But I can tell you with great confidence that if I can sit in front of the chart, given the things I'm talking about here, if that environment is in fact what's in play, that's when you saw me going out there and saying every 1 minute fluctuation, and it would be perfect, like perfect. Now, for some of you, when we're starting on day one with this workshop, these may be deflating. It may be, well, I was really hoping you were going to teach me how to trade every day. I will. But I want you to also know that if you don't have the experience to know what it is you're doing, and you don't have the discipline and the personal responsibility, and those factors are, you can't find them in today's social media. I mean, nobody wants to be accountable. They delete their live streams. I never delete my live stream. Never. Nothing that I put out there is getting deleted. Tweets don't get deleted. Videos don't get deleted. Nothing. Okay? Because you're going to make a mistake. You're going to anticipate or expect something, and you may have all these things that I've covered here. You've gone through the process and you've arrived at what you want to do. And then the time comes at the news driver event, high impact or medium impact news driver comes, you anticipate the specific price run like you want to, and then you engage it, you trade it. And it pans out a little bit, and you move your stop, and then you get stopped out. And you're going to feel like, oh no, this is horrible. I got stopped out. And you won't go back in. I'm going to teach you on Tuesday how to know when to get back into a trade when you get stopped out. How to trust the bias. And then on Wednesday, I'm going to talk about how you can trust to let your trades run. There's a lot of individuals that I see trading. They've gone through all the hard work of being willing to sit in front of you on a live stream. That takes a lot of courage, folks. It takes a lot of conviction, and it takes a great deal of moxie, balls, if you will. Okay? It takes someone that just simply has the ability to discount everybody else's opinion. But I promise you, every single one of them, when their stream is done, they're feeling everything then. They're feeling the peacocking if they did it right, and they're also feeling like, man, I don't even want to look at the comments because I know I'm getting drilled. They're dealing with it, but they have the ability to just push it away while they're live streaming. That demands respect. That's why I'll give you an example. Matt Miller. I watched the kid for about 2 years, and I shouldn't say kid. I mean, I guess to my age, he's a kid, but I simply adore him because he's not out there trying to be braggadocious. He's a very simple guy. He's not trying to be over the top, and he's doing something right now. And I've preached this, okay? Find something that's small, a low-hanging fruit objective. Once you get it, stop. And I don't know. I haven't been on social media the last couple of months because we went through some things with our family, with my mother-in-law. She's going to be with the Lord now. But obviously now I'm back in the saddle here. So, but I saw a thumbnail, and he said in the thumbnail he's taken $160,000 out of, I think it's Apex. Forgive me if I'm saying that wrong, but I think it's Apex. It's a company like Top Step or whatever. But the fact that he was able to take $160,000 out, I haven't seen anybody else do that this year. Now, there may have been someone that's made more money, but from my understanding, and I haven't watched everything he's been doing, but that sounds pretty respectable, don't you think? Did you make $160,000 this year so far? I'm not talking about fishing, Pat. I'm not talking about catching fish, okay? I'm talking about trading. And he didn't do over the top stuff. Real simple. He told you what he's going to look for. And then on top of it, he live streams it. That guy should have more followers. He should have more viewers. In my opinion, he's the #1 day trader on YouTube right now. Yes, I said it. Because he's doing it in front of you. He's proving his payouts. And it's working for him. And I'm going to suggest to him in this presentation, because I already communicated to him. I said, you're the reason why I'm going to do this lecture series the next 3 days. Because I want to encourage him, because he's feeling what everybody feels. When you have something that works, the numbers start speaking to you, and then you want to do what? I want to start cranking it up. No. See, you're trying to appease everybody else. Don't. Because that $160,000, you have to pay taxes on that money. Your audience isn't. You worked for it. You took the risk. All those things. So when you have windfall victories like this, and it's consistent, you have found your unicorn. I'm telling you, with 32 years experience, you have what works for you. If you tinker with it, Matt, I'm telling you, if you tinker with it, or you try to push beyond the bounds that you've discovered works for you, it's going to unravel. I've done this myself. I've seen students do this. I've had a lot of people that I've engaged in the last 32 years. I've seen them do explosive profitability, and they had something that worked amazingly simple, and they tried to do something more with it. You tried to turn a hammer into a screwdriver, and guess what? You mess it all up. You have exactly what you need. Now, it doesn't mean that you can't have another model on another account trading. That's something, yeah, I would encourage that. But what you're doing right now, dude, you're smashing it. Like, you're killing it right now. Everybody that's ever trolled you, they aren't doing what you're doing. They're not doing what you're doing. And you're not out there beating your chest. As far as I'm concerned, you're the #1 day trader on YouTube. Matt Miller, Trades by Matt. You should all be watching. You should all be watching this guy. Because he's not out there, he's just casual, he's talking. And then when he feels like he wants to take a trade, right or wrong, he does it. That's what it's supposed to be like. Not, I'm trying to be king of the hill. I'm not trying to tear somebody else's company down. I'm not trying to prevent somebody to do this and do that. This guy's been trolled by a lot of people. What are they saying about him right now? What can they say about him? He's got his head in the charts. He's on the grind, and he's focusing on what he's trying to do. But he's admitted that he's feeling that tug of war. He wants to do more. You don't need to do more. Trust me, if you continuously do what you're doing, you're going to have a year that's a banner year. That means your results are going to be so over the top by doing the least. Man, that is absolutely what everybody wants to do, but can't do it. And you're doing it. So kudos to you, man. But that's exactly what I was teaching in 2022 and 2023. Find a model. It's simple. You don't need to be trading the full range. You don't even need to know bias to do that. You don't need to know bias. You just need to know how you're going to engage. And what's the smallest threshold of profitability that you confidently can see happening every single time you sit in front of the charts. And also give yourself permission that if the conditions are not there for you to take a trade, turn the charts off and get out of your house, get out of your office, put your phone away. I promise you, your consistency will go through the roof. Your drawdown will be minimized. You still will lose trades, obviously. I mean, everybody loses trades. But you won't be ground down to powder because you're trying to do more than what's required. There's essentially 20 trading days in a calendar month. Generally, there's about 2 of them that I don't like to trade on, no matter what. That's non-farm payroll and the day before non-farm payroll. FOMC, I'm not afraid of FOMC. I'll trade on FOMC. The Mondays that I do like to trade are this week. Why? Because if you look at the economic calendar down here on Friday, what does that say? Non-farm payroll. So I know that even though there's no employment data, no economic data, no news drivers with anything to speak of in terms of high impact or medium impact from Forex Factory's calendar. There are things that are occurring today, but generally this is kind of like a light day. But we're also in earnings season. So all these things are going to create a wild week of trading. So I want to ring this in right now. When do I avoid daily bias? When do I avoid not forcing a bias on this event right here? We have FOMC this week. We have rate announcement. We have non-farm payroll. Look at this calendar. This is a minefield. So I don't expect myself to go in on a week like this and say, okay, I need to know what the daily bias is on Monday. I need to know what the daily bias is on Tuesday. I need to know what the daily bias is on Wednesday. I need to know what the daily bias is on Thursday or Friday. I don't. I give myself permission to not have to worry about that. So what does that mean? What do I do? Well, you have the conclusion that you're either going to not trade or you're going to trade. If you're going to trade, how are you going to trade? You're going to trade without a bias. That means you're going to trade intraday volatility. I have to be very careful what I'm about to say because some of you take my audible clips and you either use them in the right context, and the people that don't like me take them out of context and they make them something that I didn't say. With experience, and when you can determine when everything is in your favor for the market to be slated, bullish or bearish, and have a sustained price run higher or lower, those are the best conditions to trade in. But they're not the only conditions to trade in. When I'm trading with a market environment that is without a daily bias, I am never trading with my highest leverage. I'm not trading with 4.5% per trade in terms of risk. I never do that. I will never open myself up to that. So what is my risk per trade when I'm in a market environment where I don't have a way of discerning with confidence the assurity that I've already described how I have the assurity and confidence to do it on certain days? When all those factors are equal, then I will risk the maximum. If I miss the initial move, whether it be stopped out and I have to re-enter, or I just get to my charts late because, hey, I have a family. Sometimes, nature calls and I have to relieve myself and I just can't be in front of the charts. I'm a real person. I'm not AI. I'm a real person. I may be tied up, with something that my family requires me to do. And then I get to the chart and I miss the real ideal entry point. Then I'm going to risk about 2.5% maximum. But if all the things that I just described, if I miss that and I had to just use a fair value gap to get involved in a move that's already maybe 40% on its way, and I have 60% of the unrealized range still left to be delivered to the price, then I'll trade with 1.5% risk max. Now, I just covered a very vast array of questions that I get a lot. There's nothing I can do audibly or write into a book that's going to make that any more plainer or straight to the point. It's so plain and straight to the point that it's boring, and it's boring the socks off you. But that's the stuff that makes you or breaks you. See, you're going in with, I need to know the days that ICT wants to trade and the days that he wants to know when he wants to be a buyer or seller and where he knows the high and the low today. There's a lot of things that are required for that. And that's not an everyday instance. An everyday instance is unrealistic. And you can't obtain that. No one's going to be able to obtain that. Why? How can I say that with, a surety? Because manipulation is always a factor. You don't know how many times they're going to pass through an old high before they drop it. You don't know that. You don't have the experience to see that yet. You don't have the experience to determine how one single pass above a short-term high, that's enough. That creates the high of the day. Hold it and ride it through the rest of the day. But we're going to cover those things today, tomorrow, and Wednesday. So it kind of gives you a foundation and a framework. So anyway, that's enough about all that. And that's the big rocks, if you will. These are the big heavy hitters that are used for me to determine a bias. Now, already some of you probably have 1,000 new questions, and I love that. I love it because that means you're engaged. That means you're here to learn. So I'm going to transition over into price action. And we're going to look at some charts here. And what I like to do is start with the daily, weekly, monthly view of the dollar index. Now, because of all the things that's going on around the world, specifically with the Middle East, I expect the dollar to appreciate in value graphically on the chart. But that doesn't always equate to more value in your spendable dollar. Okay. The dollar is going to go higher if we have an escalation in what's going on in the Middle East between Iran, Russia, Israel. All that's blowing up, and that's going to impact your trading, whether you like to believe it or not. You might like to think, hey, in the United States, it's happening over there, so we ain't got to worry about it. No, all that stuff's going to impact the marketplace. So it's important to know these things, okay? And we've gone through Passover. You know, we're on the other end of that. So I expect things to ramp up over there. So what does that mean? That means that I expect a possibility that the dollar goes higher. That doesn't always equate to immediate sell-off in index futures. They can move in tandem initially. There could be ugliness where it's up and down real quick, and then it starts going higher because of flight to safety or flight to quality or risk off. Risk off is dollars higher. That means all other markets are likely to decrease. But when a geopolitical wartime event happens, it's not always mark to market. It's not everything's moving perfectly in sync, because those initial moments, the market makers use that opportunity to clear the board, meaning they'll go north, south to the farthest extremes and wipe everybody out. That is why I am not trading Forex. We are going to see a major banking collapse. It's happening. You don't want to believe it, but it's coming. Okay, another bank just failed this weekend, and a major bank in the next 2 weeks is likely to fold too. A big one, something like everybody knows these banks. Okay, but these smaller banks, they've been failing, and that's why I won't touch Forex, because something really bad's about to happen, like when the euro and Swissy was depegged. And that was craziness. It's crazy town. Like, I don't care who you are, how much money you got, you're done. Your ticket's punched, you're out of there. Brokerage firms, investment firms, large traders were buried when that happened. And there's no way to protect yourself from it. It's so instant. It's like, bang, it's over. You owe more money than you have. So it's for that reason. And because I don't know how to time that, because it's outside of my control. It's outside of my, I don't have the pay grade to have the intel to know when that's going to happen, but I know it's coming. So I just segue back to where I started in commodities and futures. And I'm fine with that. But the things I'm discussing are germane to every asset class. So whether you're, let me rephrase that, not crypto, because I am not a person that understands crypto. I don't have faith in crypto. I do not buy crypto. I don't sell crypto. I have no affiliation with crypto. I have nothing to do with crypto. Okay. And I sell the idea that it's going to zero. And I can be sitting here telling you that, and it can go to 1 million. I didn't lose money, and I don't care what anybody thinks about it, because I don't want to address crypto. I think it's the beast system. I'm not going to trade it. I'm not going to use it. I'm not going to spend it. And that's I'm not going to talk about it. So there you go. I can't get any plainer to the point, and that's why I don't touch it. So all the things I've talked about here up to this point and throughout the entirety of this workshop this week is germane to futures, commodities, bonds, currencies, and index futures. So everything is the same. It doesn't matter. It's all going to be viewed the same way. If I'm looking at any one of those individual asset classes, I'm internalizing the things I've covered so far. So, when I go into the charts, I go right to the dollar index first because I want to get a feel for risk on, risk off. If the dollar is likely to go higher, how do I know that? Well, we start with a monthly chart. Now, you don't have to have your charts laid out like this. Okay, if you have a laptop and you have a membership to whatever platform you're using, I use TradingView simply because my community asked me to use it, and I have no affiliation. Even though they asked me, I would receive something from them. I turned it down, and I have saved and screenshot it in case I'm ever asked. I don't get any compensation for talking about the tools or resources that I employ or use in teaching. I don't have any reason to tell you something's good or bad except for my own experience with it. That's the opinion that matters. It's not influenced. I'm not biased because I'm getting my pockets lined. Okay, I'm not producing anything that's a kickback to myself. But TradingView, you can set this up where you're just looking at one chart at a time. But I will say this, whether you're using TradingView or any other platform, if you can have 2 or 3 time frames visible at the same time, or if you have the luxury of having multiple monitors, you don't need it, but if you have the luxury of having that real estate, you can have a whole lot more insight by having more time frames in front of you. But if you don't know what you're looking for, was what I opened this lecture up with today, using that higher time macro perspective and working your way through that, then finally going into the charts. Having more charts and more monitors isn't going to help you. It'll be just one more catalyst for you to get in and lose money. So you still have to know what you're doing. So what do we do, and why are we looking at these time frames? What is it we're doing with them? Up here in the upper left-hand corner, that's a monthly chart, and I'm going to maximize it just for a moment. So this is the dollar index. I don't care what you trade. Okay, I don't care what you trade. If you're not referring to the dollar, you're not doing effective analysis. Okay, it doesn't hurt my feelings when people say that, that's not true. I can do this with that. Look, there's a lot of people out there flipping quarters and making money. Okay, I don't attribute that as skill. You might want to call that skill. I don't. So when I look at the dollar index, what I'm looking for in a monthly chart is, where are we at right now? Well, that's pretty obvious. It's right here. Where did we come from? Where did we just leave energetically? And how was it left? It's real crucial. And the things I'm talking about here, that's the same thing you're doing on a daily chart. It's the same thing you're doing on a 4-hour chart. It's the same thing you'll do on an hourly chart. The same thing on a 15, and same thing on a 5-minute, and same thing on a 1-minute, and the same thing on a 15-second chart. It's not being reinvented. You're not trying to learn something, apply something entirely new just because you're looking at a different time frame. But the price delivery continuum is how price is offered to us from a higher time frame perspective, like this monthly chart, down to those smaller time frames. Where are you at on that 15-second chart in respect to what we are doing on the monthly? How many times have you looked at the chart with that perspective? How many times have you lost money and then peaked at a monthly or weekly or daily chart and said, man, why did I go long when this thing was clearly looking to go lower? Because you'll have the benefit of 2020 hindsight then. But I'm teaching you what it is I do every time frame, but I'm placing a great deal of emphasis for determining bias or feeling comfortable with trading a session with one direction better than the other. But I may have conflicting analysis on the higher time frames. We may be in a position where, okay, it's done something, and I'm going to cover what you're looking for in a second, but I'm kind of like give you moments where I may look at these charts on the monthly, the weekly, and a daily, and they have already done something, and now they're just sitting there where it can go either way. Then that moment, I'm basically going to go in and trade intraday volatility. Then I'll look for these 10 to 15 handle runs in the NASDAQ and be content with that. Not try to reach for 50 handles, not reach for a 100 handle day. Because the likelihood of that delivering is low. Not that it can't happen, but my ability to be in there on that one individual price run on that given moment and that session after the market has done something or entered an area on a higher time frame, monthly, weekly, or daily, where it could sit there for a day or two and nothing really changes on the higher time frame, but it just sits there. That's frustrating, especially if you're trying to squeeze a 200 handle run out of something that isn't going to move more than 40 or 50 handles for the daily range. You're trying to force your will. You want something that isn't going to be offered to you. And as a new trader, I fell victim to that because I thought that things I saw in books were going to just spring into action every single day. And it doesn't work like that. This workshop is going to teach you what does happen every single day and how that smallest little component can be used as a small component with another one just like it that makes a larger component or another larger opportunity, and how they nest. And that's the price delivery continuum, how we can look at all these time frames and pick buys and sell. You want to learn how to be a buyer and seller in the same day? You're going to learn that this week. You don't need to buy anybody's courses. Okay, I'm going to show it to you. It's going to be on live price charts. Okay, there's no better way of learning it. Okay, there's no better way than seeing it happen. Now, I didn't measure the delay or latency on this stream, but I always have it set to the lowest one. So whatever that is, that's what we're at. But here, if we're looking at the monthly on the Doppler, we have this up here. Now, we had a nice little run there, but now we have done what? We moved back into this inefficiency right there. I'm going to try to avoid putting a lot of markings on the chart. So just take your time and watch the video and play back, and you'll see what I'm referring to. But on your chart, you should definitely putting this lipstick on it. This inefficiency, we entered into that right in here and outside of it. So this candle's low. That candle right there, that candle's low. The price is 105.36. Okay, so that low for that individual month, October 2023, we have traded to it and through it. This high right above that is going to have what? Buy side liquidity. To the left of it, we have this inefficiency right here. Below us, where did we come from? Well, we came from this low here. What did that do? Consequent encroachment. This wick. See that? 50% of the wick. Wicks are gaps. Okay, that's how you should look at it. The algorithm, I know you don't believe there's an algorithm. The algorithm sees these wicks and treats it as a gap. Okay? So whenever you see a wick like this and it created a turning point, a lot of folks will look at, if they're bearish, they're going to see that low as support. And if they're bearish, they want to see that support be what? Broken. I don't look at that like that. I look at half of that wick and then the upper quadrant. Those are the most sensitive price points when you're bullish. If you did not write that down, you missed a golden opportunity of seeing something that repeats every single day. Intraday charts have this happening all the time. I want to learn how to trade candlestick patterns. Okay, well, this is one of the strongest ones, and that's not in your books. Find it. $5 million if you go through and find all my stuff rebranded. You ain't gonna find it. Now, these lows here, that was taken out. So that was a purge of sell side liquidity. Any drop down, we have this big long wick. I'm not thinking we're going to take that low out. Why? Why would I expect that not to be taken out? Because when it went down, it took out the sell side, but further to the left, what did it do? It rebalanced this inefficiency. This high of that candle and this candle's low. That little gap right there. That's a buy side imbalance, sell side inefficiency. Fair value back by classification, but it's an up close candle. So that means it's a buy side imbalance, sell side inefficiency, or BISI, B-I-S-I. It rebalanced there. Did it displace after doing so? Yes. Did it take out a short-term high? Yes. So any retracement down, if that wicks like that, your eye should be right there on the midpoint of it, which is consequent encroachment, or the upper quadrant of that wick, which would be essentially right around here. And look where the bodies of the candles are. Right there on the upper quadrant. See that? That's algorithmic. That's not random buying and selling pressure. Because if you're saying that price moves simply on buying and selling pressure, what you're essentially saying is the 90% club that loses, they're directing the price action, and they're not. It's the people that they're losing to, because it's a net sum zero game. 90% of people lose money on trading, but because it's a net sum zero game, there's someone winning on the other side of that. So there's a group that's 90% winners. I'm telling you how they think and how they operate and how they engage in price. But you don't look at it like that, because it's unobtainable to you unless you know how to look at price. The game is played by taking from. That's it. That's how this works. It's presented to us as these are investment ideas. Build your future, build your nest egg, blah, blah, blah. Just like casinos, they show you all the glitz to make you get out there. And once you're out there and you lose your money, you're like, wow, this isn't what I thought it was going to be like. I didn't really have that much fun, matter of fact. And it was very expensive. So when we're looking at price, it's the same way. It's casino time. But you're not gambling. You're waiting to see the gamblers sit at the slot machine. See that? I got it right. Use a choke up and can't figure out what the hell they're called. The slot machines, there's a pattern that these people, they do walk around like sharks. And they want to see, okay, it's this time on my clock here, this person sitting at that slot machine, and they've been going for a long time, and no big jackpots have been paid out. And they do what? They get up and they walk away. And then immediately, boom, they jump and sit down and they play that machine. Why? Because those payouts are based on ratio. They'll pay out based on a number of money going into it. That's how it works. That's their system. It's play it enough times, eventually they'll make more money than they have to pay out. But you're just trying to make a little bit of money. The people that are cruising in the aisles waiting for the dumb money to get up away from their machine, that's what you're doing as a trader. Street money's in here trying to expect this low to be taken out as support to be eventually broken, or even maybe retested, because that's what the books say. Look, we went down here and bounced away. No, in my mind, I'm going to look at these wicks like that. So if we open up a session in analysis and the market was trading down here, then I would be expecting reversal patterns to form on the daily, the weekly, the 4-hour chart. And then once I get some kind of confirmation there, then I can trust going into a hourly 15-minute, 5-minute chart and buy side unbound, sell side efficiency, fair value gaps, or buy down close candles after displacement. And then I have an order block. You missed it, didn't you? You didn't write that down. These are the parts you're supposed to be writing down. Those factors that are agreeing, it gives you bias. It helps you frame a narrative. Narrative, essentially, by definition, is understanding how the market will price an asset where it can do the maximum carnage for the express purposes of unseating potentially profitable speculators and then assuming their position and then quickly running in a direction that allows them to profit, but affords nobody really a state of mind till they can go right back in and feel like they're doing a thing by re-entering it. That's what narrative is for me. I'm looking for maximum carnage and harm for the less informed traders. I can see what's going to be the reason or catalyst for them to lose or enter too early or on the wrong side of the marketplace. And when price delivers that very thing, that is the thing that gives me the green light that I can now take a trade, because I've seen the manipulation. I'm not trying to be a part of the manipulation where I'm a victim of it. I'm watching it unfold. It's like, there's going to be a car accident. If you ever seen a train hit a car, it's just like that. You can't stop that train. It's not a moral dilemma. You can't, by yourself, move that car that the person saw they can't get out of the way of the train. They got out of the car. They got their children out of the car. So no one's alive in that car. They're at a safe distance away from it. And you're all speculating about how far that car is going to be thrown in the air. You can't stop it. There's no moral dilemma there for me. I'm going to watch that train blow through this car. I'm going to make sure I'm safely away from it so I'm not going to get harmed by it. But when that happens, the train passes, I have an opportunity to engage. That means the traffic that's piled up behind me is going to want to go where I'm going to go, on the other side of that track, and get out of there before all the other things that usually happen in that situation. Fire trucks, you can't move, everybody's there. The same thing with price. I'm waiting for maximum carnage. The manipulation is a timed event. You see it on the economic calendar. When there is no economic calendar event, then I heavily rely on macros. Macros are those 20-minute intervals, the first 10 minutes and the last 10 minutes of the hour that you're in, and then we start a new hour. It's the first 10 minutes. Every single trading hour is a macro. Hot damn! Did he just say that? Yes, I did. You awake? Well, they're boring you? You're awake now, aren't you? Holy shit, ICT's screaming again. It's audience management, folks. I got to get you awake. Every single, remember I told you I could trade every single 30-minute and 60-minute candle? Because there is a macro. That 20-minute interval is there on every single hour. Now, the ones that cause intermediate terms in market structure changing and turning are the ones at like 9:50 to 10:10 a.m., 10:50 to 11:10 a.m. Then you have 1:50 to 2:10 p.m. and you have 2:50 to 3:10 p.m. They are the ones that you should study them first. But when you get really good with knowing what it is you're trying to look for, I'm not done with that yet, but I'm giving you a lot of foundation here. This is what would look like filler in a book. You know, there's going to be chapters, unless you understand and appreciate what I'm showing and discussing here today, and we're going to apply in real price action, you won't be able to appreciate the level of wow factor, because it clears a lot of the questions that you have about what it is you should be doing, what you shouldn't be doing, when things should happen. What do you get when you have a news driver that is a 10 o'clock news event on a day where you have a seasonal tendency behind you and the market structure supposing that it moves in that same direction that the seasonal tendency implies, and you have a high impact news driver or a medium impact news driver at 10 o'clock? You think you're going to have a good move at that time? You're damn right you are. And if it's done maximum carnage by going higher, slightly higher, and then at 10 o'clock that news driver goes a little bit higher than all the highs it's been there, but you've been bearish, that's so beautiful, because I will take that as a turtle soup and I'll sell short. And then when it has a shift in market structure bearishly, I'm going to sell the first fair value gap that's bearish. I'm going to add on a breaker that's bearish. And I'm going to keep building every new pyramid entry I can that's an up close candle. As soon as it touches the low of that up close candle on the time frame I'm trading, I'm going to add another smaller position size and pyramid on it until I get to 60% of the range, okay, is still unrealized. That means 40% of the move has already happened. Then I stop pyramiding. I don't want to take any more pyramiding entries at 50% of the range I'm expected to see pan out on that trade. Why? Because I want to keep my last entry in my pyramided entry, where I'm building these positions where I start with like 6 contracts, and then I'll do 4 contracts, and then I'll do 3, and I'll add 2, and then I'll add 1. I want that last one to be in the upper 40% of the range that is expected to be delivered to me as my profitable trade. There's rules to this stuff. It's not random. I'm not just pulling stuff out of my rear end because it just sounds good to talk about. I'm repeating these things all the time. Go back and look at my execution videos. I can't edit it. I can't make them seem like I'm doing that. That's exactly what I'm doing. On the days that I want to do something, all things being equal, that's how I'm doing it. Now, what happens if you start trading like that? When you have a very selective process of knowing when you're trying to do something, when you're not trying to do something, you're going to have a greater command over your emotions, the psychological impact of what you're trying to do, or you're trying to avoid losing trades. By default, this will maximize the likelihood of you not suffering as many losses. It will not prevent 100% likelihood of being profitable or unprofitable. There's never ever going to be something that removes that likelihood of you losing. That's always going to be there. And the reason why that's always going to be a constant is because manipulation is always likely to occur. And that uncertainty, the things that you don't see coming, that's going to be the catalyst for you taking a losing trade. And if you think that losing trades are going to be the end of you, then you can't be a trader. You can't. Okay, so when we're looking for bias and trying to derive a bias, I start on the monthly chart and I want to see where we are. We're here. Where did we come from? We came from recently, this low here. Why did it react there? What I just explained over here, taking out the sell side. We rebalanced this inefficiency. So really, what have we said here? We've completed every necessary thing for a discount. How do I determine the discount? How is that a discount? Here's one of those instances where you can copy. That's fine. These are my settings for fit. Okay, so screenshot that. All right, so here is premium. This is the high it's been during all this drop down, and this is the lowest point it's been in. So this is your range for determining premium to discount. Equilibrium is midway. It trades up to it here. Notice it did that from high to low. It came right back up to midpoint, equilibrium. If you're bearish, equilibrium is premium. It can be treated as what? Think of it as like resistance in terms of retail theory. But there's nothing over here that's resistance. See that? There's nothing here definable in terms of classic support and resistance. So it's just the measuring of overbought, oversold in the context to the range in which the price has been offered to us. That high to that low. We are still in what area of price action relative to that range? Below equilibrium. So we are still, all of this is discount. We're in a discount market. Now, is it likely that the dollar is going to go higher or lower given this information? Well, that remains determining on what it is that we just left from. We went higher from this low, which was a reaction off of the consequent encroachment of this wick. When the wick went down there, it did two things. It disrupted the sell side stops here, and it rebalanced this. So pray tell, why does it need to go back down here? It doesn't. What has it not done? It hasn't made its way on a closing basis above equilibrium. And watch. This high here, that liquidity is buy side. I wish I would have had this stuff when I first started. I would have probably been way better if I would have known this coming in. Okay, so right away, what this does is this tells me, because I've done qualitative analysis and quantitative analysis, I've based all of my premise on the fact that, what do I have here? I have a range from this high to that low. And we're inside that range. Is it more likely that we're going to go above this high or below this low right now? Well, if you were looking at in terms of the closest proximity, most people would say, well, it's probably going to go down below that low. I'm not thinking that. I'm thinking that we're staying in a discount right now for a larger, longer term price run higher. Here's the kicker. I do not need this high to be taken out. And I don't believe that this low needs to be retraded to, because we've had confirmation here. Consequent encroachment was offered and it displaced higher. We had sell side taken with that drop here, and it also rebalanced. That's every possible thing that would constitute a reason for the market to turn higher. So the work essentially has been done on the discount level, on this chart, on the monthly. Now we have to do the same thing on the weekly, the daily, and any time frame less than the daily chart that you use for your trades. And I'll leave that up for whatever it is, because we would be needing a whole month to cover what it is I want to cover. So what I'm saying in plainest, simplest terms is we already went above this gap on that sell side imbalance, buy side efficiency. We should have been looking for it to drop here if this was going to continue going lower. And it didn't. It just kept going higher. You have mean threshold of this down closed candle, which is a bullish order block. It trades to adhere. Did it react higher? Yes, it did. It went above this inefficiency here. So what is left on the upside, or in a premium perspective? This high and this inefficiency in here. So this confluence of this high having buy stops and inside this inefficiency, and if we split that in half and get the consequent encroachment or midpoint of that gap, you have a high degree of probability. I trust, I believe, I'm not saying that you should, this 50% is equilibrium on that range from the highest high and the low that we were just talking about. And right in here, this little shaded area has buy side and up to the midpoint of this sell side imbalance, buy side efficiency. I do not need, you don't need it to trade above the midpoint of that gap to find opportunity. So where we are right now, we're in a discount. Where have we come from? A deeper discount, a rebalancing, sell side been taken. We had confirmation given to us here with the consequent encroachment of that wick. We displaced higher and we broke through what would normally be expected to see what? Hit in here and go lower. It hasn't done that. So the untapped opportunity is buy side hasn't been taken in that range, and the inefficiency over here, and we haven't gone above equilibrium on a closing basis. So there's three factors right there just on the monthly chart that tells me higher dollar eventually. Does that mean go out there right now at 941 and be long dollar, short everything else? No, it doesn't mean that. But that's the stepping stone, okay? So you build your foundation on bias and premise with that context. So I'm going to take this off here, and we're going to drop down into a daily chart. All right, so now having this stuff on the charts like this, that's that fib. That's a measurement also. Look how it's like consolidating around that. You're probably asking yourself, what are you talking about, CT? Let me go back out. That low to that high. That's this level here. This level here is equilibrium. Of the range of that high to that low. I'm going to just keep your eye on this level right here, okay? Watch. I'm going to take this off. See how it disappears? That's the low of that shaded box. That's halfway or equilibrium, the midway point of the range from that high to that low. This one here, the upper line, that is the level that creates the midpoint of this inefficiency from here to here. And I'll show you that by deleting it. See how it goes away? So that gives you the calibrations to when we drop in the lower time frames. That's what those levels are. In your charts, you may want to put a little line segment on it and annotate it with, monthly sell side imbalance, buy side inefficiency, consequent encroachment. And that would look like M-SIBI CE. So that gives you all the details as to what you're looking at on a lower time frame. Otherwise, you won't know what that level is for. You don't know what that line is. Okay. So with that said, let's go back down into a weekly. think I was in a daily chart before I should have been. I think I was, yeah. So here we have the weekly chart and the same thing here now. We look at what it is that is likely to occur. Inside that little blue box, that's the draw on liquidity for ICT. Michael, I believe that that's where the dollar index can draw to. But now when we entered into the weekly chart, we have new imbalances, short-term buy side, relative equal highs. It does not change this. It confirms, in my opinion, it qualifies it more as a likely draw on liquidity. And if this is true, and time will remain the deciding factor here, if it draws up to here, you want to go through your charts and back test every turning point that unfolds from this point forward until it gets up to here, okay? We have this inefficiency right there. You can draw that out. I'm not going to, but I'm going to show you how it went down into that buy side imbalance, sell side inefficiency, and it touched exactly on its consequent encroachment. The low is on that candle, 105.414. It went just below it enough to hit it, but not go drastically below it. Did it react there? Yes. Then we opened, traded down. We can have initial, because it's Monday, we could see it drop down and close in this inefficiency. Personally, I'd like to see some of this left open. Why? Why does ICT like to talk about certain candles that are a fair value gap? Why does he like to see some of it not close in? The fact that we're where we are in price, we've already came down and traded into an order block. That's this one here, this down close candle. With a fair value gap, it dropped down once, twice into the fair value gap that's formed and touched the order block, the last down close candle. Within the context I've outlined it. That's why this is a down close candle that we can call order block. All the things that I have been jawboning on from the monthly chart, trading down into, well, not trading down, but adjusting our focus to now a weekly chart, the down close candle in this instance here, that constitutes and makes that a valid order block. That's not a demand zone. That's not a engulfing candle that does this or that. It is an order block. The opening price of this candle right there, that is the change in the state of delivery of price. Meaning, that is the very trigger. That's the catalyst. It's not this range. That's not a zone. I'm not looking at a zone. I could care less about supply and demand. It's a fallacy. To me, all they've done is taken support resistance levels and made it more ambiguous by calling it a zone. How the hell are you going to find the right price inside that? How are you going to do that? How are you going to do it consistently and be able to say, this is what I'm going to use all the time? They don't teach that. You have to figure out something still. Okay, I've done all the figuring. I know what price I'm looking for. So if we're seeing how prices already reacted here, and it showed displacement, it rallied up into this high. There's a lot of order flow that's going. And remember, this is a weekly chart. Upper left-hand corner, you see that's a weekly chart of the dollar index. We're still just working out the risk on or risk off. It doesn't take you this long. It's taking me this long, so I want you to understand. I want you to know why I do certain things, when I do it, why I am not interested in certain other things, and when I'm going to consider other things that we've yet to talk about. Because I'm trying to teach you how to do it without having me help you anymore. You want to have that mentality that's independent. That's what I'm trying to foster in you. I don't want to spend my days doing long-winded talkings. I do it so that way it helps answer a lot of questions that you don't see coming to me. And I'm doing a great deal of, or putting forth a great deal of effort to make sure that I'm communicating it to you in a manner that I can only do it this way. I don't know how to do it any better than that. And I've already said I'm not the best mentor. But to understand what it is I'm doing, this is exactly what I do. So when I do it, you can have a framework to say, okay, this is what he does. But it doesn't take this long. when you do it. Like I said, I go through the dollar index. I do the indices, the Dow, the NASDAQ, the S&P. I use a handful of major currencies like the pound, the euro, to solidify risk on, risk off. That doesn't mean they all have to move in concert with one another. We will talk about Forex to kind of like build in the comfort level that it still works there too. But there's also details that you want to be able to glean from using the concepts. Even if you don't trade other asset classes, their input technically will support or negate an idea, or it'll have a factor that weighs on me in terms of how much I'm willing to risk per trade. If everything's in agreement, man, that's like a lead pipe cinch trade. Like that's a given. It's going to happen. But if I have half of the things I look at that is telling me, yeah, these things should be going lower when the dollar goes higher, I'm not going to risk my maximum amount of leverage because of that factor. You see how all these things, there's rules. There's rules to these things. And it helps you graduate to a level of comfort because you're following rule-based ideas and processes and protocols. So that way your attention is focused on adhering to that process or protocol versus, am I going to make money? Is this going to stop me out? What's going on? Who's doing what with another? Let me pull up this live stream and see if they're trading a Dow today because I'm looking at the NASDAQ. I want to make sure I'm picking. How do you know that person's even going to have the right one too? You're guessing whether or not you have the right one. Just trade one. If you get stopped out, who cares? If you have a system that works, you're going to get a winning trade and that loss will be mitigated. But it doesn't need to be mitigated immediately. But that's what you want because you have a TikTok mentality. Give it to me right now and it's 3 days late already. So we've had this inefficiency traded to and displacement to the upside. Now we have this inefficiency here. And we traded down to it here. There. And now we want to see price ideally leave this open. But because all of the news events that's due out this week, what can we allow for in our analysis? Are we going to demand that it stays open and be hardlined about it and dogmatic? It has to stay open because ICT said so. No. I would prefer that it stay open and not completely come all the way back down and touch this candle's high. I'd prefer that it doesn't do that. Because if it does that and remains open here, that this swing low on the weekly chart can be trusted, and it's probably going to move, if not this entire week, going into next week, up into here to draw to that buy side. Because these stops here, they made money, but they're squeezing on them. And because there's no inefficiency in here now, in this range, what is there? It's the focus on the stops. And those stops also reside in a monthly inefficiency over here that doesn't look all that inefficient until we get over here. So I'm not trying to make a hardline case that we're going to trade up into here. I don't need that. What's the low-hanging fruit? Where's the level at which I need to focus on, and it's all I need to worry about for this given week or this given day or session? That the likelihood that the market could gravitate to here. And for all the reasons and factors I've already mentioned. But let's say you're a scalper and you don't have the confidence or the ability to stay with the trade because you don't have the experience yet. You'll have to learn how to do that over time by taking demo account trades and tape reading and staying in it when you feel like you want to get out. Just stay with it and see what happens. Don't trail your stop loss too tight. Don't strangle it, and just let it happen. If it can't encourage you to hold to this type of move up here, where's the next short-term buy side? That's this high here. So you could take that and that would be your short-term scalping draw on liquidity for today, tomorrow, and Wednesday. Now, that's not a lot in terms of range, but it's enough for you to take a euro and cable trade in. If it runs here for the dollar index, that's going to send the pound and the fiber market, euro dollar and pound dollar, lower, because dollar up causes what? Risk off. Risk off will be assets decline. There's no interest in buying them. So they'll go to a discount to encourage purchase. So this is the draw on liquidity on the very, very short term. Intermediate term, it's this one here. Longer term, this inefficiency here, which is both weekly and monthly. And then maybe, but I'm not going to tell you because it's so many uncertainties that's in the economic climate right now. I'm not going to sell the idea that I'm going to say it's going to go up here. It could. If we have a nuclear bomb dropped off any country in the Middle East or even in the mainland US, nothing's off the table. You're going to see dollar go 135, 150 because that's a shock that no one's ready and prepared for. But I'm telling you, we're going to see that. We'll see it before. We'll see it. Let's leave it at that. I got to be careful what I say here. I'm on YouTube. The short-term draw on liquidity is here. Intermediate term draw is here. Now, with that, we can drop down to the daily chart. Man, we finally made our way down to it. Now we have this inefficiency. Look how many times we've been in here. Once. See, we're there. Lower, 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 all the way down into here. Notice that we completely went outside the range of this buy side imbalance, sell side inefficiency. But it was only on the basis of what? The wick. What did I teach you? The wicks do the damage. The bodies tell you the story or the narrative. The bodies are stopping inside of that inefficiency. See that? I'm going to show you here in a different color so it pops. Okay, so we dug down. The bodies are telling you the narrative. It's the storyline. Yeah, we went down to that level, but that's the weekly chart's fair value gap's consequent encroachment. It's the midpoint of the weekly. So the price delivery continuum, moving from the higher time frame down the lower time frame, we're teaching you how to effectively look at it algorithmically from the top down, not using retail logic, not using support and resistance, using inefficiency and or order block. It's one or the other. That's the turning points, okay? The turning points are going to be liquidity based or inefficiency based. Entries are always formed on the basis of inefficiencies being retraded to or order blocks being repriced to. If you don't have that written down, you missed it. So the bodies are telling us what? We have done what we need to do. Yeah, we went lower, but don't be scared now. Don't be afraid. Even here on this candle here, on this daily candlestick, we went just a little bit outside of the range that frames that fair value gap. So when you look at my live examples, or where I've also talked about it live and did live tape reading with you, and I'll say, okay, this is normal, this is completely permissible, it's outside of the range of the fair value gap, but it's a mohawk. It's like a little tiny coloring outside the lines. And I use the analogy, if you have a child and you give them a coloring book page, a color, they colored outside the lines, but you're never going to tell your child, look at this, you idiot. Look at this, you messed up. Look how you colored outside the line. You're not doing that. They colored it and you put it where? You put it at your desk at work, you hang it on your refrigerator. You have an affinity for that. Well, when I see my algorithm constantly doing what I want it to do, I had that same thing. I expect it in certain instances to color outside the line. How do I know when it's likely to do that? Because I want a higher time frame, like we just had on that weekly chart. That's this inefficiency here. That's these levels here. And it only went down to halfway point of it. Rewind the video. I have it on DVR settings, so that way if I say something, you can quickly rewind it and then click the live button. I'm not deleting anything. Every video I put up is never getting deleted. Okay, the live streams don't get deleted. So if you can't watch the whole thing, or you can't stay with the whole session, it'll be here when you come back to watch it. But this dropping down in the lower time frames, that is absolutely permissible because of the higher time frame inefficiency. Now, how far can it trade down? It could have ultimately traded all the way down to here on a wick. Why? Because it's a weekly chart inefficiency. That's the low of the inefficiency on the weekly chart, and the high was that level, and the midpoint of it's here. That's why it went down there. But now, because we have had multiple instances of this, and we have one more pass here, and it didn't go below that low on this one here, where I would have demanded it had done that. If we can keep this candlestick from closing below here, everything I'm talking about, I'm still sticking with a bullish dollar. That means risk off. That means that, yeah, indices might rally on the short term, but I'm more interested in eventually seeing it roll over and give me an instance where I can get short because of the underlying risk off scenario that may be unfolding in the future. So that right there is the 85 to 90% framework of how I determine daily bias. Now, how do we segue from the daily bias to a session bias? Well, we've been trading at 9:50. I did a good job. I want to make sure I was in the indices by 10 o'clock because the opening range is done. So we're going to go into NASDAQ. NASDAQ. And we are on a daily chart. So we have no news really to speak of that's all that impactful today. We have huge news events tomorrow, Wednesday, Thursday, and Friday. Okay. So if you're going to be looking for trades today, try to keep them as a scalp because the large range deliveries, the big runs, the big moves, okay, in other words, don't try to demand a 100 handle run on NASDAQ today. It's highly unlikely. It's not probable because that's being reserved. All that movement is being reserved for these impact drivers that's going to release Tuesday, Wednesday, Thursday, and Friday. So it's like expecting to see your favorite baseball team to come through the corridor and get a signature from them the day before the game. You might be there, ready to stand there and hold your little pen or hat out for a signature, but they're not there. So the big plays aren't going to be here today. They're going to be there tomorrow, Wednesday, Thursday, and Friday. So the reason why I timed this, whether you would have put 10,000 likes on the post or not, I was going to do this anyway. But it's this week I wanted to teach bias because this is the week that's the hardest one to derive it. But the things I've said about when it's not this week are so simple that you'll be able to be fine with it. Okay. But this week, you want to try to avoid holding a daily bias over yourself because you're not going to know the daily bias. I don't know the daily bias. There's too many catalysts for the market to go into a wild, just craziness. Trust me, this week is going to be crazy town. You're going to see a lot of volatility. You're going to see price runs that are going to go against what should be obvious. So what does that mean? You need to be a scalper this week. You need to be a scalper. Pick your shots. When you get the range you're looking for, your 10, 15, maybe 20 handles, be content with that. Take majority of the trade off and then see what you can get on any kind of runner. But don't hold with great deal of conviction that you're going to get this one-sidedness. It could happen, but it's more likely that it won't because we have all these things that are happening all in the same week. We have FOMC, rate announcement. We have non-farm payroll. We have, good grief, everything else that was listed on that economic calendar. So while it will present a great deal of magnitude in terms of up and down volatility, and that's wonderful for short-term intraday trading, it's problematic for sustained one-sided runs, which is what daily bias is helping you focus on. Daily bias, the only real essential necessity that I attribute to it is for a new trader, what side of the marketplace should you focus on? If it's one-sidedness and it's bullish, then you should be looking for those macro times or the opening range once it's completed. That will give you the intel to tell you when and if your buy is likely to be trusted. Filtering out going against the daily bias. And because you don't have experience, that right there will limit your exposure to risk because you won't be trying to go against the daily bias and you won't get tripped up when the market starts to move parabolically against what your daily bias is. You don't get tricked into chasing price. And if you do it wrong, it's okay because you're going to do it wrong forever given enough times to trade in a month. You're gonna have losing trades. Trading is managing losing positions. That's what trading is. All your entire career as a trader is going to be you managing equity drawdown. Everybody has it. Everybody, experiences it. And where do you go from there? That's what trading is. And your goal is to make money by the end of the year. You can't determine how much you're going to earn, but in the beginning, you have to keep the money aspect out of it, because if that's the reason why you're trying to learn how to do it at a rushed pace, that's going to be the very catalyst why you blow up. And you're only looking at it from one side, because that's the side that you want to experience. So with that said, we have on the daily chart, the market has moved from this high down to that low. So we have a range. I'm picking this candlestick high because it's the up close candle and it's the highest high and that low. Okay, we are essentially above equilibrium. We've closed it there, so we're above equilibrium on Friday, and then we have today. We're sitting around in an indecisive day, which is classic for what the economic calendar shows us. To the left of that, we have this right here. What kind of inefficiency is that? It's a sell side imbalance, buy side inefficiency. It's a down close inefficiency or fair value gap, which is a SIBI, S-I-B-I. About 15 comments are going to come to me. You could do this if you do this, that, hold control. I know. So this sell side imbalance, buy side inefficiency, that is the premium draw. So because of the volatility, because we mentioned how the dollar could trade lower a little bit, because of the volatility that's likely to be seen and witnessed because of all the economic calendar events that's on the menu for this week. If the dollar drops down a little bit, it could send us into this fair value gap here on the NASDAQ. So you want to have this level, and you also want to have the consequent encroachment and quadrant levels on that inefficiency. And I'll show you how to do that now. On your fib, you should have a setting down here for 0.75 and 0.25. What that will do is give you the upper and lower quadrant. That level right there is the midpoint, which would represent a consequent encroachment of a gap or inefficiency or wick, or it would be equilibrium in the dealing range. Okay, so, and this is the high and low of the range that you're measuring. But these levels here, that should be toggled. And what that'll do is it'll give you the gradient levels inside this inefficiency because we're on a daily chart. So in plain English, I suspect that we will see us go into this range here. I am expecting it to trade to the low, the lower quadrant, and as much as the halfway point or consequent encroachment of this inefficiency. That is my Monday, Tuesday, Wednesday bias. That's all I'm holding for in terms of what it can do. Now, with that said, if it can go beyond this midpoint on a closing basis, but doesn't go up here yet, then I'll anticipate the market resuming when it opens at 6 o'clock later in the evening time. I might take an Asian session trade to try to reach up in and get that inefficiency closed in. Or if it consolidates and drops back down to the low of that inefficiency during Asia tonight, going into London in the morning between 2 o'clock and 5 o'clock in the morning Eastern time, I might take a long if it did what I'm explaining and then try to get a run up to get that closure there. Or tomorrow's New York session, I might be interested in seeing that trade there. You see how everything moves from, if it does this, then I will do that. If it does this, but not that, then I have to sit on my hands and wait. It's not, well, I have a bias, so let's go out there and just start pushing buttons. And then you wonder why you didn't get the results you're looking for. You have to take your time pick your shots, know what you're looking for, but that knowing what to look for has to be in line with the time of the day. And since we have really nothing to be a major catalyst on the economic counter to create some big explosive type moves higher or lower, we can spend more time with this type of analysis to build where the market can go to and why it would be more likely to do this than to go lower. So much like I just outlined with the dollar index, we can see the framework here. We have the market turn here. We rallied up. We had a single down close candle. It traded into this down close candle on the daily chart. That opening price is the very price that causes the change in the state of delivery. What that means is it will now change its directive to now seek premium inefficiency or buy side or a combination of both. So my order block is not a supply and demand zone. I'm looking at the opening price. If it's a down close candle or an up close candle, that is the very trigger. That's the mechanism. That's the price. That is the salient point. That's the bullet point. That's the factor that you're looking at. That's the very thing. That's the key crucial point of information. That opening price. That is going to tell me everything I need to know in terms of where the market's going to reach for, how it's going to deliver, the speed, the magnitude, is it going to continue, and where that order block is in market structure is going to tell me if it's going to be a target, if it's going to be an initial entry, if it's going to be a factor for where my stop loss should be placed above or below, respectively. All those things I'm going to be teaching you this week, but I can't compress it all into the first lesson. And it's not important that you're watching this live. So if you're able to watch it afterwards, that's fine. But you're going to need to watch these 3 live streams several times because there's going to be a lot of information in it, 3 decades of it. But that opening price, that is the change in the state of delivery, meaning that now, because what we were doing was we were going lower, seeking a discount. When we went above it, when the narrative suggested that we could potentially turn and go higher, the technical aspects to it is that down close candle and its opening price. Now, watch. I'm going to put this opening price right there, and we'll make it blue so that way it's very large, it's prominent, you can see it. We're going to go down to the lower time frames in a moment, but that price is like a trampoline. Think of it like that, okay? When price is above it and Trump trades back down into it, it'll create, if it's good, it will create feedback in price delivery where I call that a signature. If price on the lower time frames are supporting or it rallies away from it and then creates a fair value gap above it, I'll take that as a fair value gap entry and go long if it's a scalp and get 10, 15 handles, 20 handles if I can and be done. And that's trading without a bias. Light bulbs, right? So we'll come to that in a second, but the market traded down here into that candlestick right there. Same thing. We're going to do it with a smaller one. ICT's delivering information on the order blocks now. Finally! There's so much stuff to it though. But this is the simple, direct, right to the point. So that way it gives you useful information. The down close candle, where are we at in respect to the range from here to here? We're still in the discount. Here's the equilibrium price point. So this down close candle is absolutely crucial information for you taking trades. But this is a daily chart. So you have to allow for coloring outside the lines if you're using lower time frames. So it can do a whole lot of things beyond that specific level. But I'm going to show you what you're looking for that constitutes and qualifies a setup. One that you would see me outline like when I was on Twitter saying, okay, look at this 1 minute candle right now. Go back to this 1 minute candle. At that range, we're looking for that fair value gap. A lot of the goobers that were watching that went back and tried to take things out of context and said, look, he was looking for a sell. You did not hear me say sell or buy. I'm taking your attention to that very fair value gap because if we can trade above it, what will that be? An inversion fair value gap. And if it trades up to it and rejects it, then we can take that information used for a subsequent setup or PD array to get short, whether it be an up close candle for bearish order block purposes or a smaller time frame fair value gap that trades up into it that would be a trigger point to get short. It's for me to teach you live where your attention should be. And by using that information in the context of a narrative and a bias, that's your full panoramic view of how to engage markets for trading purposes. But in the beginning, you shouldn't be pushing a button, not even on a demo. You should be practicing and just studying how price delivers, because then you can see it without any monetary reward, no pain and suffering if you did it wrong. Nobody saw you expect it to behave a certain way, and you journal that. And you sweet talk yourself saying, I had fun, I enjoyed watching this today, and I learned that the market had difficulty, not you, the market had difficulty going below this specific PD array. And I was thankful that I could observe when that occurred. And I'm going to do more research to see why it did what it did there when the week closes. Where does that event fold, or I'm sorry, fold, not fold, but unfold in the grand scheme of the weekly range? So you're not giving any negative to your journal. You're identifying areas where maybe you were watching the tape live, or maybe you did do a demo trade and it didn't pan out like you thought it would there. You're not vilifying yourself. You're not being highly critical in a negative sense, but you're very reasonably highlighting areas of opportunity for you to discover more information. So it's real important that you manage yourself that way in your journal. So we have two down close candles here. You have bullish order block in the lower portion of the range, the lower half. Once we get into real close to that equilibrium price point, order blocks can become 50-50. And it really demands your understanding of why you think it should go higher anyway. Because you could see a down close candle at or just above equilibrium, but if you lose the sight of where over here can it trade to, it could be just trading to a short-term premium and then collapse aggressively. And you may be thinking, well, I'm using an ICT bullish order block and it should go to the moon, baby. And maybe you didn't use a stop loss because you think you're going to be right. And it comes back and does damage to you. That one event, that one trigger moment where you didn't do what you were supposed to do because you had everything all in Texas Hold'em style and you had your rear end handed to you. That one small little event in your entire career will be magnified. No matter how much money you make, that one little piece of scar tissue is going to be a barrier and a hindrance to you doing things that you would have otherwise done more efficiently because you hurt yourself, not listening. So anyway, this candle's high. That's the draw on liquidity for me initially. Then it's this specific price point here, 18,021, because that's the lowest quadrant that's above the lowest of this fair value gap from that candle's low and that candle's high. That's your fair value gap. So it's this. I'm looking at this range here. But the very specific price points in that range I have based on this. The lower quadrant, and this is not quarters theory, by the way. Okay, find this in quarters theory. It's not there. What I'm doing is I'm grading a price swing. The price swing is the difference between this candle's low and this candle's high. And because the markets are algorithmically booked and delivered, they're going to go to this level, and then they're going to go to that level and that level. And how I'm using this information is I want to see a trade here. That would be a nice area to target first. Then if I have a long position on, then it would be this level here where I would take a partial. And then I would take 80% of the trade off at that halfway point and leave a runner on to see if the daily range can, I'm not saying it's going to do this today, folks. I'm saying this is my Monday, Tuesday, and Wednesday bias. I want to see E-mini NASDAQ trade up to that. That's what I went into the week with that. I'm giving it to you live as I'm doing it, and I'm telling you why and how I came to that conclusion. I didn't just pluck it out of the air. And this method or process is what I do every single week and every single day. Now, if it can close above that midpoint of this fair value gap, which is consequent encroachment, that price being 18,054.25. If it can close above that, then I would expect, whether it be Asia, whether it be London or New York session tomorrow or the PM session, I would be looking for reasons to justify how it would go up and close in the upper portion. But if I can get a long in around the equilibrium of that range or inefficiency, consequent encroachment, the midpoint, that price, then I would take a partial at the upper quadrant because it doesn't have to fill that in. You see what I'm done? I've removed the necessity of being right. I have to be right or it's not profitable. Bull. You just need to be worrying about controlling the drawdown, managing risk, and when the market affords you an opportunity to pay yourself, you pay the trader. That's how this works, folks. But you have to predetermine where you're going to try to aim for a partial. You just can't just feel like, oh, my elbow's twitching. Last time I had a muscle cramp like this and I was in a trade. It turned on me. So, I probably should take one now. Let me take a partial off now. You're trading from physical stimuli. You know what you're trading off of? Cortisol and adrenaline. And nobody's thinking clearly when that's going on. So you have to have your levels for targeting, whether it be partial or conclusion or terminus, where you're completely out of the trade entirely. They have to be determined before you enter the trade. If you can't time your entry and get in it with a target and where your partial should be, you shouldn't be entering the trade. Because what you're going to do is you're going to enter and you're going to find out how you feel as the trade goes along. And what that means is you may have had a small inclination of a market trading 10 handles, but because it moves 12 real fast and sudden, now you're in there for a whole day. And then you'll watch that profitable day. You might get 30 handles, 40 handles, 60 handles. And you're like, man, I'm going to the bank today, honey. Pack the bags. We're going to Vegas, honey. And at the end of the day, it's gone. And you lost $1,000, or you blew your funded account, or you blew your trading account. Instead of saying, I'm not just trading today. I'm trading until I can't do it anymore. And I don't have the mental faculties or the equity to do it, or the markets are kept from me. I'm going to be trading. So therefore, I have to do this as a business. I want to take profit at this logical price level. And I'm showing you how to logically frame out low-hanging fruit objectives. You don't need grand slams. You don't need to complicate it. And if you think this is complicated or complex, I don't know what to tell you, because there's all kinds of other stuff out there that's busy work. And it doesn't prove its effectiveness at all. I teach my students this stuff. They use it. They're on the leaderboard #1 spot in Robbins. They're cashing out. I got 1 million profit students. They've taken $1 million out of the marketplace using what I'm teaching you for free. I could go right into mentorships and start making millions of dollars again every single month. I don't want to. I don't need to. I love teaching you. I want you to learn it the correct way. That's why I talk to you in great detail, because I want you to know, and you're not going to learn it the first time you go into the video. You don't need to come back to my video and watch it and give me ad revenue. Download the video. I don't need your ad revenue. I really don't. I really don't need that. But I really need you to learn how to do it correctly, because there's a lot of yahoos out there that are teaching something they don't know anything about. And it's hurting more people than it's helping. And because they're using my terminology, but it's supposed to be rebranded bullshit, why don't you just go talk about the rebranded stuff that I supposedly did that? Call it what you think it's been rebranded and make it work in your charts. Make it work in a live stream. Make it work like that. Win competitions, get withdrawals from funded account companies, show broker statement, do all those things. Because I have students all over around the world that are doing that. And they're attributing what they've learned right from this YouTube channel. And some of them paid to get this information. You're not entitled to it, but I gifted it to the community because it's been abused by people. And to keep them from making money, I gave it to you. But I love teaching. I'm a teacher at heart. If you don't want to follow my rules, you can't claim that my results or your results are attributed to my concepts. You can't do that, because you're doing things inconsistently. And what I mean by that, what I said earlier facetiously, where if you don't have a predetermined level where you're going to take a partial profit at, based on the logic and the analysis that you're doing, you're going to be left to fall victim to whatever you feel while the trade's going on. And obviously, if the market starts going off the rails and parabolically in your favor and wildly beyond where you thought it was going to go, you won't be able to see anything except for dollar signs, and it's all going to be champagnes and bottles popping and Lamborghinis. You're just thinking, I'm getting rich on this trade. Everybody has experienced that. Everyone. Well, not everybody. There's been people that's never made money. But the folks that has ever had a winning trade that has gone beyond what they initially thought, they remove their stop loss. They don't have a target. They don't have any limit on it. It's just open-ended. I don't want to get stopped out, so let me take the stop off because I know it's going to go to the moon. And that should never happen. It should never be allowed in your trades. You have completely lost the plot. You don't know what you're doing, and now you're gambling. You're literally at a slot machine just hoping that the 777 is going to pop up or whatever it is that uses the payout. By having these easy objectives, these low-hanging fruit objectives, you don't need it to go to outside the range you're trading in. You don't need it to move 100 handles. If there's a logical reason for it to go higher or lower based on a higher time frame chart, and you can see a pattern that I've taught ad nauseum in this YouTube channel, that's it. That's your model. And if it's working for you, don't change it. Don't invite others to critique it. That means when you make a lot of money with it, don't go on social media and say, look at this. You want someone to say, well done, pat you on the back and handshake you. Someone that trusts their model and that can do it repeatedly and consistently, they're never going on social media and asking for approval. They have their bank accounts that's approving them every single week. Wow, I made more money this month than I had in the bank the previous month. I had this many withdrawals from my account. My broker sent me this much money. My funded account company paid me out this much money. What more do you need to make you feel good? That's real. The reason why you want to go to social media is because you don't have the consistency and you know it's probably not going to last. So you got to get it while you can. Get your accolades while you can. That's the wrong way of doing it. You put that stuff in your journal and you keep counting the money after you're out of the trade. You don't count it while you're in the trade, but you have to know when you're getting out. Where are you taking profits? Because unless you have that predetermined, you're going to lose sight of everything while you're in the trade. And that's going to affect your adherence to your bias. You don't think it, hearing me talk about it like this, but if anybody's ever traded real money or even trying to pass these funded account company challenges or whatnot, or the classic scenario, I only have $300 and then I can pass my funded account and I'm going to go for it today. I'm going to find $300 somewhere. And then you find yourself without an account. Classic, 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 classic. My best advice is if you're in a situation where you're right at the threshold of getting a funded account or getting a payout, that's the easiest way to say, you know what, I'm going to take 3 days off. Do something else. Because if you know how to trade, you'll be able to come back after 3 days and be sober-minded about it and get that last little piece and get it. But you're all in a rush. There's no reason for that. Like, if you do it fast-paced to get to it, look how many times people try to, I passed it in 1 day. Okay, how many payouts have you got? How many times did you blow those accounts that you passed in 1 day? The speed factor needs to be balanced with, I'm going to just do this slow and steady, and I'm not trying to do it quick. I'm not in a race with anyone else. I'm not in a race with statistical probabilities that a good trader can pass it in 1 day. That's a gambler. And yes, there's a lot of professional gamblers, but there's not a lot of professional gamblers that are profitable in trading consistently long-term. And if you want to be a short-term gambler, there's lots of ways to do it. I'm not the guy to teach you that. I'm trying to teach you how to be boring, how to be in here like a business, a job. It's not a surprise when you're successful. And when you're not successful for a day and you lose, that's not the end of the career. It's not the end of the business. You're not boarding up the building and saying we're out of business now. But that's predominantly what you see in this industry where it's flash, boom, here it is. Here I'm showing up. I'm here. I arrived. I got a funded account. I'm passed. And then they're using another account 2 weeks later. You shouldn't be impressed by your progress of how many times you can get a funded account. That should not be a measurement, ever. And I tell this to my own students, and sometimes it's met with emails saying, I thought you would encourage me. I am. I'm encouraging you to focus on what matters. Getting a funded account passed, where you're now able to take money if you're profitable and you meet all their bullshit extremes and levels. Now they're talking about you can't trade in a short span of time. Everything I'm telling you is going to happen, folks. It's just, you got to wait for it. These funded account companies, they're going to be gone. All of them, they're going to be gone. So you have to do the right things while you can, but don't rush it. And when you make real money, that money needs to be placed into a real regulated, reputable broker and trade with the least amount of leverage, never more. And then you get real experience. And when you can take money out of the marketplace and pay your groceries, pay your car note, and stop worrying about buying Lamborghinis and shit like that. If you don't listen to these rules, I promise you everything I'm teaching and have taught already isn't going to help you, because the problem underlyingly is you can't listen and you won't be teachable. The rules are there for a reason. They're created in a manner where they're low threshold. That means this is the lowest that you can reasonably frame it. And if you're not content with that as an initial objective, you're being shown that your expectations are too elevated and too high. And without any experience, you're going to be met with frustration because you're trying to do something you're not equipped to do. And you're going to fault yourself. You should have been able to do this sooner. You should have been, I've always been good and academic and everything else. My uncle was the same way. You can't equate that to being successful. But the underlying root causes are not sticking to a process or protocol. And if you're asking me to teach you bias, I've done that today. But you want something that is, this is what it's always going to look like. It's not like that. You're seeing where price has been, how you came from there, where you at right now. Are you still in a discount? Is it likely to go higher? Okay, your mindset should be, I'm focusing on how price is going to go higher. Now, right away, there's Tom, Dick, and Harry's mentorship guys out there saying, well, talking about the market and calling the market is not trading. Yeah, that's exactly the truth. Absolutely the truth. But you can't reasonably expect to be consistently profitable following a methodology, whether it be mine or anyone else's, until you have a process that you have seen work in the hindsight, that you've measured the data. It works this many times more than it fails this many times. Is there a reason for you to stick with it using the rules, not your own stuff, not your own elbow aching the last time I had that tennis elbow when the market went 150 handles, and now I got gout in my right big toe, and last time that happened, I blew my account. So you're equating everything and every catalyst for things that are outside of the market, because we're human nature. We're humans, rather. We fall victim to human nature, where we do things and we personify things that are never really factors that cause the outcome of anything. And that highlights the necessity for personal responsibility and accountability. And you need those to be paramount in yourself as the trader. When you make money, you made that money. I did not make that for you. My concepts did not make that for you. You did. You used something to cause the decision to be made. And then you stuck with that decision until the time that you closed that trade. I promise you, if you wrote an essay out on everything that you did using a winning trade and a losing trade, and you were honest with why you did it, what you were thinking, what you were feeling, every emotion, I promise you, the least factor will be my concepts or anybody else's methodology. That's the secret. You're the fucking problem. You have all this baggage in the beginning that you got to sort out. And nobody does an adequate job, unless you're talking to me, because I'm going to point out everything you're doing wrong, because I did all those things. And until I corrected them, I was not able to do this. I put all these other things in front of me when the least was enough. The least of these things that you're worried about is enough to derail you. The least in terms of profit objectives is enough to retire you. But you won't accept that. Why? What is the underlying problem? If you make $100 a day and you're consistently able to make $100 a day, if you can do that consistently, all you have to do is multiply that. That's the easy part. Multiplying is easy. Being able to consistently find that $100 cookie cutter. It may not be $100. It might be $200. Might be 50 bucks for some of you. But you have to be able to measure this continuous approach to doing the same boring shit that has the outcome that is going to give you the end result you're looking for. You do not need to have one contract yields paying out $2,500. You don't need that. You just need something that yields you profitability. If you're an S&P trader, okay, let's take a quick look at S&P. ESM 2024. All right. Excuse me. Actually, you know what? We've been going for a little bit. Let's take a 5-minute intermission because I need to get something to drink and you probably need to use the restroom. So let's go for a 5-minute intermission here and then I'll resume. All right. So far, it should have been worth the price of admission, right? Tuesday and Wednesday is going to be much, much more invested in the time of reading price action live and explaining things. But we have to have the foundation. And like any book, you're going to have chapters that are essential information. That's what we wanted to cover today initially. If you discount that stuff in the beginning and you try to fast forward all that stuff, and you, in the past, when I let people comment on videos, they'll invariably have like the video starts at this minute marker. Their jerkers are never going to make any money. Like they literally are omitting the important factors. The stuff that you want to be explained why this is important, why you should be looking for certain things, and why you should discount other things outside of what I teach that are distractions. So anyway, real quick with the S&P, because I do want to spend at least an hour or so with live price action on the very, very small time frames. We have a fair value gap here. We've colored outside the lines just a little bit, but we have this wick. See that? Remember I was showing you with the wicks on the NASDAQ? The same thing applies here. Consequent encroachment, which is the midpoint, that's level 5,190. The lower quadrant is a price I can't see. I don't know how to read that. Can't see it, so we'll try to get a rough idea. 51.78 3/4. Okay, so even though we can go outside of the range of this fair value gap, why could that happen? Well, if you go back to NASDAQ, we have a lot more range that could happen in unfolding buy-side delivery, not buy-side liquidity. Buy-side delivery is just expansion higher directionally. It's offering buy-side delivery to NASDAQ in this area. We're below that fair value gap. So if things are allowed to see dollar go a little bit lower, but not undo everything I said about it, NASDAQ can go a little bit higher, but S&P is already inside its fair value gap. So what premium rate exists for it if it's going to be allowed to trade higher in sympathy with NASDAQ? Should NASDAQ trade higher? We have to use this wick. This wick is a gap. Okay, so we would look at the opening price here, the quadrant, the lowest one here, and the midpoint. Same thing. Now, with this, we have something that brings another depth of bias, narrative, prognostication in terms directionally, and also input that we can now use for market structure. If we close above this midpoint or consequent encroachment of that wick for the S&P, because we've already went above its respective fair value gap, like this date here, April 15th for S&P, that gap is the same gap that's here for NASDAQ, April 15th. We've not yet made its way up into this gap on NASDAQ, but we have gone to it and poked outside of it on ES here. So if it's trading here in ES and we close above that, that to me signifies that we're probably going to go higher and maybe and very likely take out the high. So that means we have a change in the overall market structure. And I mentioned this on April 8th where, because we're in an election year, yes, I'm expecting hundreds of handles lower. Seasonally, it's likely to happen. We've seen that. It's 1,000+ handles in NASDAQ that went lower. But if we see that it's an election year, the seasonal tendency in the spring can many times be abruptly changed, and we can see it resume going higher if it's a bullish year and it's an election year. So that would constitute, if we can close above that here, that might be a marker delineating the change in the underlying direction of the marketplace, where right now I'm favoring higher dollars, so that's risk off, and I'm looking for reasons for a higher time frame trade to be implemented. That is not to say that I won't take longs intraday scalping where I don't even need to have a bias. Okay. So all these factors build on the dynamic of understanding your daily bias, your weekly bias, and now I want to talk a little bit about session bias. Okay, we're going to go back into NASDAQ. All right, so here's what we have for the NASDAQ on the daily chart, and I'm going to drop right on into a 4-hour. Be mindful that these levels here, this is the order block's opening price on the daily chart for NASDAQ here, and the opening price on this down close candle, which is an order block. Those two price levels, we're going to study that in a little bit greater detail, and I'll try to teach you in concert with that and other things how we can trade without a bias. Because let me say this again, I'm not trying to encourage you to trade without a bias initially, because you're going to be challenged by that. Because what happens is when you don't need a bias, that means you have a whole lot more opportunities. And that's going to sound exactly what you're looking for. I have a lot more reasons to make a lot more money, when in reality, it just means that you have a lot more excuses for why you blew your account. Because smaller time frames offer a plethora of new, very short-term strikes where you can get in, get out, get 10 handles, 15 handles, be done. In and out, 5 handles, 6 handles in the S&P, you're done. What I try to promote is looking for one of those per day. You can study all the other ones that you'd be interested in, but try to find one that you would be real confident saying, okay, this is the one, everything's good. I'm going to try to get it and stop, because there's no other way to forge and build self-control until you start doing something like that. So please don't take this segue into shorter term time frame setups and reading intraday price action on these very small time frames. Don't take that as an invitation by me to say abandon everything and just go out there and just have at it, because I think it's more reasonable and responsible of you, and certainly of me as the educator here, to try to filter out the majority of the things that I know that you're going to see as a setup that isn't there. It isn't going to be a good setup. And that's part of the learning process. You'll know what your model is that you like and trust. And because you've been doing it enough, you'll know the setups that look like, I can see how someone else with less experience would see that's likely to occur, but I'm not taking that one. And when it doesn't pan out, that feels so much better than making money. You don't understand that right now because you're not profitable yet. But a profitable trader knows exactly what I just said is truth. Knowing when not to do something, and it did exactly what you thought was going to happen, where in your infants of learning how to trade or using your model or your concepts, whether it be my stuff or anybody else's, you just think you see everything all the time because you want it to happen. Maturity comes when you're like, okay, I can see how that setup could trip me up early on, but now I got more experience. I don't trust this one. Yes, it could pan out, but I'm not taking that one. It's not worth my money. It's not worth my mental capital. It's not worth my peace of mind. So I'm going to let that one pass. And regardless of the outcome of me not taking that trade, I'm okay with it. It's not going to change me. It's not going to create an impulse in me to now take another trade because I didn't do that one. So now I'm mad at myself. You completely eliminate all that stuff by having a bias and operating only in that. And then you forge personal responsibility and maturity, and then you'll have the end result you're looking for, but you can't envision it or visually see it within yourself because you're still in that doubting stage where everything is an invitation to justify why you shouldn't learn from me or even trade anywhere, because nobody makes money. Nobody does anything correct. Everybody's a scammer. So you have a lot of stuff to work out and wrestle with in the beginning. So the easiest way for you to get through that is have a protocol, a process, and stay within that. But the good news is when you get through that stage and you know what a real good setup looks like inside of bias, then you can graduate into saying, okay, I want to do exercises, and I'm going to show you how to do that today. I want to do exercises on how I can learn to read price action and expect certain things to happen in price and desensitize yourself. And when you're using lower time frame setups, you're gonna get a lot of them. You don't need all of them to pan out. In fact, in the beginning, it's good for them not to all pan out, because that's how you identify the ones that are better. You compare and contrast the characteristics of the ones that did pan out versus the ones that didn't pan out. And then you include the element of time, because the time factor is going to tell you why the ones didn't work. Hello. So we're going to look at a 4 hour. All right, so here we have a 4 hour chart, and here are our respective daily order block levels. Notice that there isn't like 20 of them on the daily chart. There's not like 15, 7, 4, or 2 is good. 4, 3, or 2, that's good, because you're dealing with daily ranges, okay? And the expectance that you may have when you first start doing this is you think order blocks are happening every 5 minutes on every time frame. And you have to be reasonable, because in a protracted price run, that means where it's continuously moving in one direction, higher or lower. In an up move, ideally, you only want to see a few down close candles, because that tells you there's a lot of strength in this up move. If you see a lot of down close candles forming, that means either you're at the consolidation midpoint of halfway of that move, or you're probably near the high. In the next run it goes up, it's going to be that's the end of it, and it's going to collapse. And that right there, if you didn't write that down, you missed the whole thing today. Because down close candles in a up move, they should only be there for new opportunities to buy. Period. If you start seeing a whole lot of them, that means they're opening the auction up to, hey, look, come on, we want more buyers. And that's the red flag. The more down close candles you see in the time frame that you're trading when you're bullish, the more likely you're at either consolidation, and that's good news if you have a higher time frame objective or target where you think the market's going to draw to. If you start seeing a number of down close candles starting to form around in the general proximity of where you're at in price action, you're usually at a consolidation point. That means you're at basically a midpoint of the next price leg will repeat what you just experienced. So it's like a measured move type thing. Think of it like a classic bull flag, okay, where that pause, that little consolidation, is just the midpoint of the overall larger move. And a measured move is just a replication of the first leg up, now will be repeated, but many times it's done so in 3/4 or half the time. So all these down close candles and up close candles or order blocks, they give you intel, not just a entry or a target or a means of managing your stop loss, but it also gives you insight in determining the strength and the underlying probability of the continuation of that price leg or run that you're part of. Ideally, you don't want to see a lot of down close candles, but when you do see them and it does return back to them, you want immediate respect. If you don't get immediate respect, the same thing holds true. You probably are at a turning point, and any rally that comes off of that, the next candle or the next candle after that, within 2 candles of hitting that order block, if you don't get the responsiveness, or if it comes off of it just really lackluster, you're probably only trading up to a short-term premium, which would be model 2022 or a breaker, and then that's it. It's over, and then they're going to pull the rug and it goes lower. That's stuff that I've never taught before. I did not include that in the paid mentorship because I got jacklegs in there that are trying to sell it. So that's why I don't make content for them anymore. I answer their questions. I ask them, tell me what you would like me to address in this workshop. I'm addressing a lot of their questions and their concerns in this teaching, but I'm making it public. So that way nobody can repackage and, well, they will be writing books, all this stuff now. You'll see it's on Amazon. ICT's secret to order blocks. He's finally spilled the beans. Whatever. The point is that I didn't teach this anywhere else before. And it helped me for 6 years in front of them live every single day, calling the market, telling them what was going to happen on a weekly and a daily, a 4 hour, a 1 hour, a 15-minute chart, a 5-minute chart. Like, I was on the record, and I was very consistent using these types of things that you now have in your hands. Just because you now heard me say the words doesn't mean that now you can walk out there and say, I can do this too and try to push buttons and try to pass combines and whatever. You still have to go through that graduated stage in the beginning where you have to see it for yourself. You have to see when it doesn't work and ask yourself, why did it not work there? And do personal inventory. Are you upset about something? Are you mad? Are you impatient? Are you trying to force something because you want to do what somebody else has done and they got so much money as a withdrawal in a funded account company, or they did something in a competition, or they did this and that? You're trying to do things that are outside or external to yourself. And as a trader, you got to keep everything personal and private. And I know that doesn't fit some of you that want to be rock stars on social media, but that's all bullshit. Your house being paid off, your car having no note, your bills being completely paid debt free, and all of your utilities are constantly being met by one trade. One trade in one session of one day out of a whole month. And everything you make beyond that, after you have taken it out of the account and you've paid yourself, that's the real paying, not just closing the trade. You got to pay yourself. When I say pay the trader, that doesn't mean collapse the trade. That means take the money out. Take the money out. Go have a meal with your spouse. Take your wife out to dinner. Take your husband out to dinner. Spend it. Make it tangible. Because when you do that, it's going to inspire you to be diligent about following rules and not over leveraging and risking. Because you're going to want that experience more times than you just want to get the rush or the high out there, seeing a move happen in a demo or a funded account, which is a demo. And unless you get the money in your hands in your bank account and you spend some of it, it's an illusion. But that illusion is extremely powerful, and it's going to cause you to behave a certain way while trading because you're trying to keep up with the Joneses. You're trying to appease the people that are looking to you. But you invited that. And now you've created a situation where, hey, I'm not trading to make money anymore. I'm trading to impress other people. And that rarely works out well. So don't bother doing it. Does that mean you can't show a profitable month after it's done? No, it doesn't mean that. But as a steady diet, here's what I did today. Here's what I did today. You're basically giving yourself a report card and letting other people critique you. And that is going to impact your daily bias. You're going to second guess every little fluctuation. So you asked me to teach you daily bias. These are all part of that. Some of you are just saying, get on with it. This is all part of it, folks. My students that have made money, my students have suffered and never been able to find their own model and adhere to rules, I'm preaching to them. I've had students that just recently, even in the 2016 group, they have finally, think about that now, they have finally found profitability. What took so long? Them. You all have the same content. You have the same lessons, the same rhetoric, everything. But they are the issue. The ones that made money sooner, they were the catalyst. They didn't recklessly plunge in there and do stupid stuff or outside the parameters. They stuck to the parameters. So I'm teaching you today, I've taught you the process of going through the market, and you do the same thing with every asset class or market you're going to trade. But I start with the dollar index, because it gives me the risk on risk off scenario that I measure. That does not mean or equate that a higher dollar or a bullish dollar bias equates to let's get short NASDAQ, S&P, Dow, let's sell short gold. It doesn't mean all that. It just means that is where my mindset is. And I want to focus primarily on setups that fit that criteria versus just taking any old trade. Now, how do we use that for very small short-term time frames? Well, we're going to look at how in this little area here where we had that order block number on the daily chart, we're at the 4 hour now. Okay, let me go back to the daily. Here's the framework. Here's that last down close candle. So when we look at 17,530.75, and when we look at this price level at 17,682 even, that's these two respective order blocks on the daily chart. And they're order blocks because we're in the lower half, or in the discount range of this high to that low. See how that price leg just stands out? It just jumps off at the chart. You're using that as a frame of reference. This is the most logical price run we just had. Now, in that price run, there are smaller price legs. We'll talk about that on Tuesday. But for right now, for daily bias and session bias, this is enough. Okay. So they're order blocks because they're in a lower portion or in a discount relative to the range that you're using to qualify the down close candles to be a bullish order block. And because it's a higher time frame daily chart, they have a lot of influence over price. They're going to be very influential. So having them on your chart and drawing them out like this, what price are we looking at? Well, it's inside the zone. Wrong. It's the opening price. That is the change in the state of delivery. That means that the market will now seek buy side premium arrays or liquidity. That means buy side or buy stops. One of the two or a combination of both. But it's your job to go through the charts and say, okay, now where is there an inefficiency? When it traded down here, you're looking at this saying, oh, see, it failed. That's a noob trying to find fault at something. We're going to look on a lower time frame so you're going to see what I mean by this. When you have a higher time frame, monthly, weekly, or daily, or even a 4-hour order block, those levels need to be transposed to your lower time frames because they will absolutely have an influence on price. And you're going to see setups that completely have been never noticed by you. But they're the same things that I'm keying off of when I went on Twitter and said, okay, let's do some tape reading. I'm going to talk live and watch this one. And some of you were complaining about how I wasn't dealing with a chart because I was forcing you to look in your own chart because that's what trading is. You got to look in your chart. You can't make your money and profit in your account trading another person's live stream chart. You can't do that. You can't do that. Not in sleep at night. You can't. Now, that's not to say you can't support other people because I like certain live streamers. I like listening to them. I do not trade off of their information. I sometimes fade them in their crowd because then they get really, really animated about their opinion. And if it's opposed to what I expect to see in the price, then I have a purest form of market sentiment there is right at that moment at real time. And I'm going to be honest, it's not to brag. It's not to be, I'm trying to be very guarded in the way I deliver this because I have a tendency to go off the rails. And I've done it a few times here, but I've been able to dial it back. The number of times that my setup, when it's opposed to euphoric feeling about, yeah, let's get it, let's do it, or when they think it's really, really bullish or really, really bearish, if that is absolutely diametrically opposed to what I'm teaching you, and I'm in the market, I'm looking for a setup that's counter to what their emotional stimuli is being shared in public, when they're like that, I have everything, all boxes checked that I have a sure thing win. And I quietly just have fun with it. You can do the same thing because everybody wants to be a live streamer. They all want to show that they can make money. But the ones that offer their chat window, they are giving you a tool that you can tap into because that is real market vein. That's real market sentiment. That's somebody that doesn't know what they're doing telling you with a high degree of opinionated concern about the outcome of something they know little about. Who's going to know more about what? The people that are able to trade and not worried about talking in the chat room, following somebody else, trying to hopefully eat the breadcrumbs off their table, or someone that just simply does it and they don't care to be looked at or talked about and have all that stuff going on around them. Clearly, it's an outmatched competition there. The street money is going to be more prone to be incorrect. And that's why I like using YouTube live streamers chat window because they are the perfect market sentiment. They're perfect. They're flawless. They're absolutely 100% strike rate. They are on the money of losing. And I'm telling you right now, if you don't believe me, go and do it. That doesn't mean go into other people's live streams and troll them. But I sit in about 5 of them. And I'm not really listening to many times the speaker of what they're saying. I'm just scrolling through and watching the comments. When I'm seeing something form on the chart, I want to see, am I seeing the public see the opposite at that very moment? And the more exclamations, the more amped up they get about it, and more adjectives added to whatever. Oh, I'm backing the truck up. Oh, it's load the boat. It's going to be such big. It's going to the moon. I'm looking for those types of things that trigger a huge emotional commitment that they went so far as to type it in that chat window. And whether they are in a trade or not, the fact that they took the time to do that, if I see a lot of that, not just in one live streamer's chat window, but multiple ones, and I'm diametrically opposed to that view, then I feel like I have a good, strong setup. And then I might initiate the trade even with a larger degree of leverage because of that. So that's the other part of what I did. So without making any attempt at maybe trying to speak ill of anyone's community, I'm not trying to do that at all. But I'm being honest and telling you that's the benefit I get from it, because I'm not trying to learn anybody else's system. I'm not trying to copy anybody else's methodology of trading. Even if they make a lot of money, I'm not interested in what they're doing. I'm happy to see it happen. I'm glad that they are doing it. I'm glad that their community get to see it. But I'm tapping into a resource that doesn't hurt anybody. I'm not taking anything away from the individuals that are sharing their opinion anyway. So I don't have a moral dilemma with it. And if you do, and you think it's ill of me to do it, then I could care less, really. But this is a daily chart. We're going to go into these lower time frames, and we'll drop down to a 4-hour. Okay, and I want to take your attention into this right here. And I'm going to highlight that in yellow. So when we drop into lower time frames, everything in the yellow is salient to the order block and order flow. And you don't need anything like level 2 data. You don't need depth of market. You don't need DOMs. It's not DOM, it's DOM. We're going to study how price behaves in this area here. And I don't need so much over there. Yeah. All right, so we're on a 4-hour chart. That's all that's necessary on the 4-hour, okay? Everything's the same that we did on the monthly. Everything's the same on the weekly. Everything's the same on the daily chart. And now on the 4-hour, we have a little tiny inefficiency between here and here. Now, when I see something like that, and you're probably thinking, is that really an inefficiency? Yeah, of course it is, because that is touching the old equilibrium. And it didn't come down to at least there. So that is a gap, okay? That gap, I'll be more mindful to see what that does on a hourly or 15-minute time frame. So I'm not going to worry about framing it on a 4-hour chart. So we'll drop down into a 60-minute chart, which is hourly. All right, now, if you look inside here, we had this candle run above the order block. That's the lowest one on the daily chart. The next candle we drop down. What does it do? It does an immediate rebalance. Now, if you've never heard me teach on this, an immediate rebalance is where the market has a nice big bullish run candle higher, or a bearish candle that has a large range that moved lower. And the immediate next candle after that reprices to the previous candle, to that big candle that just formed. In visual terms, it's this. The market rallied here. This candle went above the order block. That's that opening price on the daily chart, that big blue line there, okay? When we went above it, the next candle, we traded right back down. And what did it do? It went right back to the body or high of the previous candle right before that big candle. So when it does that, what I'm watching is it either will start its run in the direction I'm looking for, which is, in this case, would be higher. Either that candle or the very next candle. If the next candle does not run and it takes out that low, I am no longer interested in taking it along. I have to move to the sidelines. Immediate rebalance is one of the strongest things I have in my repertoire. It will basically be, like, say this candle only stopped with its low right there and didn't go as low as it did there. And it closed and it opened over here. What would it have formed? A fair value gap. But because the market is in such a rush to get somewhere where this would have been an obvious fair value gap, I'm watching this candle live. I'm watching whatever time frame I'm watching the trade on. I'm looking at how price behaves like this. And when it creates this big run like this and we open up here, I'm waiting to see, does it create a fair value gap? I'm already anticipating. I'm on record doing it. I'm on record calling an inversion fair value gap before they even form. I'm on record expecting an immediate rebalance before they even form. Go back and listen to the Twitter spaces. where I'm calling it. Look at the tweets. I don't delete one tweet. Not one tweet has ever been deleted by me. But when it trades down to the high or the body of that candle like it does here, in my mind, if I'm bullish, that's exactly what I want to see happen. And if I can't get in on that candle, as soon as the next candle opens, I'm buying it at the market. Immediately, I want to just be in it. Why? Because it's going to perform just like this. If I'm right and everything is equal and I'm on side, that's exactly how the market should behave. And you do not see anybody teach that anywhere. Sorry, but that's just the way it is. The market's going to reprice at that price point and immediately run. And it has nothing to do with this order block. That's just one more qualifying thing for it. It has nothing to do with this breaker right there that's bullish. Low, high, lower, low. Take that range, extend it over here. That's another trade entry. I'm talking about what I'm seeing in price. That candle, when it opens and trades right back down to that candle's high, I'm in it. If I can get in there, I'm in it. Where would your stop loss be, ICT? Low of that candle, or at least the mean threshold of that candlestick's body. That would be this. Watch. That's midpoint or mean threshold. My stop loss has to be below that. And honesty, it would be really at that opening price. That's where I'd have it at. And however many contracts I can afford to take and trade and use whatever risk parameter would be. Say I was risking 2%, 2.5%. However many contracts I can afford to trade in that, that's how many contracts I would take. I would not be worried. I would not be panicking. I would not freak out. I would expect it to do this very thing. And I've shown examples of me trading with it, executing live with it, with an AMP account. I've done it in TD Ameritrade account. I've done it with live calling the tape. I've done it with demo accounts. I have example after example of it. All you got to do is go watch the stuff. It's there. But the logic is, if we get a big run candle in a direction that we're looking for, the very next candle, I'm waiting to see a fair value gap form. But if we're lucky and fortunate enough for it to come right back down to it there, man, we are in a loaded deal. It's the loaded deal. Why? Why? Did you already forget what I'm talking about already? Where is it forming? What's this blue level? That's that daily order block. It's opening price. It's not a fucking zone. It's a very specific price level. It's not ambiguous. So you need to be looking at that level in a lower time frame. And we're only on an hourly chart. You think it's just a 1 minute chart that I'm teaching students to trade on? No. You want to capture nice day trades, you're going to be using the 15-minute and hourly chart. You want to trade swing trades, you're going to be trading the 4 hour and the 1 hour chart. You want to trade position trades, you're going to be trading the daily and the weekly charts. And the same stuff occurs there. You never, ever, ever need to go below an hourly chart. You don't ever need to do that. I am just an action hound. I know I can do a lot of things in a 1 minute chart, less than 1 minute chart. And that's not trying to flex. It's just, I have a very quick decision-making mechanism in my brain. I can change on a dime. And I can trade up, down, up, down, up, down all day long. You may not be equipped to do that. It doesn't mean you're stupid. It doesn't mean I'm superior. It just means that I matched my personality with a time frame that it works well with me. 1 hour is just too damn fucking slow for me. Like I want more. Like I need to be in there doing more. And the way I've done that, because I have the experience, I have the maturity to be able to balance and be responsible with the outcome. If I lose, I can eat that. You might not be able to do that. It might be too much for you to take, 6 trades in a day. It might be too much for you to take, 12 trades in a day. And 1 trade a week may be sufficient for you, and it's hard for you to get beyond that. Okay, there's nothing wrong with that. Focus on the 4 hour and 1 hour, using the process of determining bias. But the magic happens when you start applying all these things together that flesh out a narrative. Over here, what's this blue line? That's that higher daily order block, the opening price, not some random level. It's the same level all the time. all the time, because that's the change in the state of delivery. What does that mean when ICT says it's the change in the state of delivery? Prior to that candlestick forming, the market was going a direction. It was going lower. It was a move that we called and talked about on April 8th's live stream. I said that we're going to see several hundred handles lower. I didn't talk about going higher, going lower, and it was based on seasonal tendency. Because of that, when we have a turn, you don't need to know when it turns. It can stop you out of shorts and prove to you that it doesn't want to go any lower. Then, okay, then you start measuring what I've showed you here on the daily chart. But if you want to use it to probe any long positions, or if you're confident and convictions are strong enough, you want to be a buyer and hold for longer positions higher, you can key off those daily levels like this. But in short, what's happening is if you have an order block opening price, whether it be a bearish or bullish candle, you need to have those levels transposed to your lower time frames, because you're missing trades, and you're missing many times the best of the best. Now, what happens if you can't get in on this move? Then you have to enter inside this range here, and you may or may not get an opportunity to do so. It just might happen that you don't get an instance where it can come back down and trade below a 1 minute swing low for sell side. It may not have a fair value gap that it trades down into. It may not give you a 1 minute or sub 1 minute bullish breaker. All those things can form inside this. That's why I taught every PD array that I was willing to share, because they all can be used to get into a move that's already started without you. And it will not technically be chasing, because really what you're doing is you're keying off of what a high frequency trading algorithm is going to do anyway. This isn't the only time to enter. This isn't the only time to enter. There's other places to enter, but those other places need to be balanced, because I can take and add into a position that's already established at a lower price when I'm bullish. And that new entry that's being pyramided in, because I'm using smaller position sizes to add more, I can weather deeper retracements on that later entry, knowing that it can do that. I'm not upset by that. It doesn't change my convictions about the trade. It just means that I have a smaller position. It's incurring a little bit more drawdown because I've added more, but I want to be a part of the larger move that's going to happen after that retracement. So let's look at this little piece of action in here. We're on an hourly chart here. So when it dropped down, it touched that higher bullish order block, the opening price. So it's going to act like what? A trampoline. It's going to spring. It's a change in a state of delivery. Delivery is directional price run. That's what that is. So if there's a change in a state of delivery, that means what we're saying is there's going to be a change in the direction of price. So if it was dropping, when it went down into this level here, went lower, lower, and then we round above it, this candle, the first return back into it there, what is it coupled with? It's coupled with an immediate rebalance. It's a bullish breaker with this candle here. A breaker is when you have a low, high, a lower low that takes out sell side there, and then rallies through it. As soon as we come back down to that highest up close candle, that body extended over, that right there is your bullish breaker. That is your order block. That is your immediate rebalance. That is all occurring at your daily opening price, which is this change in the state of delivery. That means what's occurring? The algorithm that you don't believe exists is now going to spool price higher. And I'm sorry, Chris Lloyd never fucking talked that. And if that offends you, go fuck yourself, because I'm tired of people leaving comments in there. I've already had Chris Lloyd come out publicly on Twitter and tell you that his shit ain't in mine. Done. But this rally, when it runs, what is it reaching for? If there's a change in the state of delivery, it's going to seek the opposing side of what? Liquidity or inefficiency. That occurs right here. To the left, what do we see? Well, we have this little inefficiency here, but it's short order to do that. We don't need it. We don't need it just to trade here. We need it to show us a run. Right in this price fractal that I'm showing right now, where's it reaching for if it wants to go to buy side? relative equal highs right here, and what? That high. Wasn't that convenient? Bang. So your model could be based on using this higher time frame order flow around a bullish order block, its opening price, which is not ambiguous at all. It's a very specific price level, very specific. And you drill down and you look for PD arrays to converge around it that supports the idea that it's going to do what? Go higher. Because the change in the state of delivery means it's going to start going higher. So if it's going to go higher, pray tell, what is it going to go up there for? And to where? It's going to go to any inefficiency in close proximity or buy stops. That's buy side liquidity. Friends and neighbors, that is short, sweet, to the point. You can't reduce it to anything less than that. It's right to the point. You can't make it any plainer than that. Now, the same thing we apply to this opening price on the higher daily order block. What's occurring here? The market creates a consolidation, and it needs to do what? It drops down into a short-term discount. What does it trade to? The order block's opening price. When it does that, it's going to act like a trampoline. Meaning what? It's going to go down to it, press into it, and spring higher. By itself, it is not useful. You need to see other things confirm it. That's what makes it an order block. If it's just a down closed candle, that means absolutely nothing. It means absolutely nothing. The price action signatures that you're looking for is a confluence of other factors that would support the idea that it needs to be responsive at that price point, at that time. Think. What else is occurring right here when it drops down and hits that order block's opening price? What's it reacting off of? What is this? Buy side imbalance, sell side inefficiency. This is buy side delivery. It's inefficient in what? Sell side. Well, if we measure that from here to here, what are we looking for? The best buys are going to be at what? Midpoint or consequent encroachment in the upper quadrant. Where's the bodies at? Forgot about that, didn't you? The bodies are telling you, they're telegraphing you that we're going higher, but we got to damage some people first. There's some bull flag traders in here that already tried to go long, so we're going to have to stop them out. But is the algorithm just going to go pull some random number out of its ass and say, well, we're going to drop down 300 handles before we start going higher? No, it goes right down to consequent encroachment, which is the midpoint of this buy side imbalance, sell side inefficiency. See, you want it to be like Chris Laurie said, where it can come down here and close in this liquidity void. That's not what I want. I don't want that. I want this piece left open. And I'm sorry, but he's never taught that. Never taught that until I mentioned it. This needs to stay open ideally. Okay? That needs to stay open. The best buys are going to happen in the upper quadrant. What looks like a premium to you, but it's not. That's the ideal entry because you're already in a discount. You didn't get the lesson. You didn't study it enough. You just want the buzzwords, but you don't know what you're doing when you got there and try to force something through ignorance. And I know that it upsets you when I talk to you this way, but there's a small sect of my community that goes around beating their chest thinking they're superior to everybody else because they can talk like me, but you can't walk like me. And it's offensive to me as your mentor, and I'm sure it's offensive to everybody else. There's a right way to do it, and there's a wrong way to do it. And this ain't rebranded anything. This is my stuff. We don't want that lower portion to be closed in or overlapped on. We don't want that. Because what that indicates is it's exceedingly bullish. This will act as a breakaway gap. That's exactly what we want. We want to see that. If we get to a consolidation place in the price run, and it creates a gap like this, where we want to leave a small portion open, that is a measuring gap. But the fact that it has to be part of a larger consolidation, or one leg of the price run's already occurred and then we're consolidating, And then we get another gap where it creates an environment like I'm explaining here. If it stays open, that to me is going to be a measuring gap. That means it qualifies that we have another price leg that's going to be equal to the initial move, or maybe even more, but it's going to do it in 3/4 of the time that it took to make the first leg, or less. So what does that mean? Many times that's your second stage reaccumulation in a market maker buy, or a second stage redistribution in a market maker sell model. Hot damn! Did he just give some gold? Yes, I did. And for free. You're welcome. You're absolutely welcome. I'll be here tomorrow and Wednesday. But let's dig into a little bit more detail right down here. This is an hourly chart. That's our higher time frame bullish order block, opening price. It's the change in the state of delivery. That means what was it doing? It was just dropping down. We're going to anticipate what? That trampoline, that springboard effect off of that level. We have to have something else. We already have it on the same time frame, which is consequent encroachment of this buy side and balance sell side inefficiency. Why? Why should you have that rule? Because ICT teaches that you don't want to see every imbalance completely closed in. That's what gives you the narrative. If it's always able to come back down and fill in every single buy side and balance sell side inefficiency, we're probably near the end of the price run. Think. They don't have any time to waste. If they're going to come down here, that means it's going to be a lethargic price run. I don't want to be a part of that kind of stuff. I want to be in the ones that take off and it's like, what the hell? This thing's flying. It's like hyperspace. Warp speed, like Star Trek. Remember when the Enterprise would just take off and everything's a blur? That kind of felt like when I was on my motorcycle doing 155 miles an hour on Pulaski Highway. I could only see like a 6-inch diameter right in front of me that was clear. Everything else was a blur. What a fucking high was that? That was amazing. That's the kind of trades I want to be a part of. I want to have immediate feedback. I want an immediate handshake to profitability. I'm not wasting any time. I want to be in the trades that immediately talk back and say, yeah, you are the shit today. Stomp around, peacock. Do everything that makes you feel good because you got a winner. Hold this motherfucker because it's going. It's going and it's going. And there's no doubt about it. Nobody on the internet is going to take you out of that. You're dialed in. You feel good because everything you're looking for is there. And guess what? When you can trade like that and you're willing to share it live and public and everything else, it comes across as arrogance because those people can't do it. And I let them have that moment. Let them feel like they're talking down to me. Oh, you're arrogant. You're pompous. You're a bragger. You're this, you're that. Whatever. When you can do it, you're gonna feel the same way. But I'm not going around stabbing people in the eyeball with order blocks saying you're stupid because you can't trade them. I'm literally giving it to you. I'm teaching it to you. I want you to experience what it feels like to do this stuff properly. I would be completely irresponsible as a mentor to sit back and let everybody else out here misinform you with ignorance. I want you to succeed. I want you to have success. I want you to make more fucking money than you ever dreamed before. And then when you have that money, I don't want you to be selfish with it. I want you to do something nice for other people. That's the story I want. That's the payback to me. I want that. I want that testimony. I don't want, I just bought a new car. I bought a new house for my mom. That's wonderful. But what did you do outside of your own? That's what I'm looking for. That's how you pay me back. Because all the other stuff I get, it's like, okay, whatever. But hourly chart, we're going to drop down to a 15-minute time frame. We're focusing primarily right in here, okay? We already have one qualifying thing, which is the consequent encroachment of that buy side and balance sell side efficiency. It should leave this portion open down here. In hindsight, yes, we can see that's happened. But that's the rules that I've taught on Twitter Spaces. That's the rules I've taught in lectures. I just taught it in the recent teaching on April 8th. You want to see that lower portion not filled in. The more times you see that, man, that is telling you this son of a bitch is going higher. Stop looking for tops. Stop trying to go short. It's going higher. It needs to go somewhere higher. That's what it's indicating to you. You can't get a better visual representation of confirming and qualifying a setup than that. That is the signature that I'm looking for. If I'm trading a bull flag, I'm not a bull flag, a bullish order block, I want the lower portion of that candlestick not to even be traded to. It can touch the mean threshold halfway point, but if it does that, it needs to immediately kick off and start running. If I'm trading a fair value gap, and I'm bullish, I want the upper portion to be responsive. I don't want to see it dilly-dallying around at all in that lower half. I don't want to see that. If I start seeing that, as soon as I see any momentum waning after it starts to run, I'm scaling something out. I'm more inclined to start taking partial. Why does ICT take this many partials off here on this trade? I just fucking taught you. I literally just told you. Now imagine, okay? Imagine that you sat down for the first time. This is your first time watching or listening to me. This shit sounds like another language you've never learned. Still. And it still talks, it seems like, oh, it's the hindsight. But you've watched me do it if you've been around for a while. You literally watched me trade this. You literally watched me call it live on Twitter. Minute by minute, 1 minute candles, outlining it, why it should do this, where it's going to go next, all that shit. I go in other people's live stream and I tell them where it's going to go before it happens. And still people doubt this stuff. You can go out here and do everything in front of them and they're still going to find some fault with you because they can't do it. So don't invite them into your problem. The problem is you solving who you are as a trader. And when you see these signatures repeat over and over and over and over again, it builds confidence. And when it's so open, it comes across as arrogance. It comes across as prideful. It's not. It's confidence. It's unshakable confidence that nothing else can come close to this. And when you get that and you tap into that, there's absolutely no fucking person on this internet that's going to talk you out of the way you feel about it because you experienced it, you lived it, you're walking it. You're making their yearly fucking salary in a week, laughing at them without needing to do it publicly. That's living well. That's the best fucking revenge. That's the best revenge. Let them talk all the shit about how you're never going to learn how to do this stuff. It's never going to work for you, blah, blah, blah. I got people that are millionaires now. Hello, millionaires that had the same shit told to them. Who are you going to believe? Who are you going to believe? You're going to believe the guy that's creating the people for free. They don't have to pay for this stuff anymore. They're going out there and they're making life-changing amounts of money and changing their whole dynamic. Their whole fucking family tree has been uprooted and planted in a new vineyard because they took the initiative to say, you know what, I'm just going to try and see if this stuff will work for me. And I'm going to put some real effort into it. Not 2 weeks, not a couple months. I'm going to stick this out and see if it works for you. And as you go, you'll see progress and you'll see things that will increase your tenacity to stay with it. And it becomes infectious. And that's why many times we are a cult. And we are the fucking cult of winning. We win around here. We win. We don't guess. We don't get in a fucking trade to make 7 handles and say, okay, it's a lot of fucking pressure. I got to get off of this, man. And then look at this. I called it. It went 50 fucking handles. No, why aren't you in the 50 handles? Why aren't you in the 50 handles in the same account that you passed? There's a problem there. You need to fix that. That's an opportunity. Instead of addressing them, you're trying to appease an audience. Fuck the audience. Let me tell you something. I want all of you to do well, but if you don't have an opinion of me as someone that's trying to help you, and you think I'm a piece of shit, and I'm not trying to be here to do anything to encourage you or do it the right way, I don't really care about your opinion. It has no bearing on how I live. The people that give me feedback and say, you know what, I really got something out of this. It inspired me. It showed something that I had an uncertainty about something. I had a doubt about what I should be focusing on here. This helped me focus on what it is I should be looking at. It really made a structural process or procedure that I need to go in and look at. This helped me. I do it for that. There's no ad revenue on that. That is exactly what I'm trying to tap into. People that are willing to want to learn how to do this correctly. They know it's going to be hard work. They know they have to overcome a demon and maybe demons in themselves that are going to be plaguing their development. I didn't cause them. Maybe you didn't cause them, but you all had them. I had them. I still wrestle with a lot of stuff. But you still have to wrestle them and put them in submission and then stick to a process of learning how to do this. Because if it's not going to be this, what's it going to be? Moving average crossovers, okay? Is it going to be pivot points, harmonic horseshit? You know, what's it going to be? Because until you fix the you problem, all these things are going to resurface, and you're not going to focus on the processes that work if you give it enough time and effort. So we're going to drop down a 15-minute time frame. Again, we're looking right at this price level right there. I gotta climb off my soapbox. Same thing in here. We're looking at relative equal lows. So there's a sell side liquidity pool being engineered there. Look what they do. They run first, higher. So what does that do? It triggers longs. Why would they want that? Because if they're going to go long, they're going to put what? Sell stops. Where are they going to put them at? Below the relative equal lows. Well, then that's convenient because right down here is that order block. And right down in here is that consequent encroachment of the 1 hour buy side and balance sell side efficiency. So now we have liquidity engineered right at a buy side and bell, sell side inefficiencies, consequent encroachment, or midpoint of that gap. Is that 3? That's 3. That's 3 things. We have inefficiency being factored in and liquidity now. So when it hits this price level, what should it do, ICT? It should act like a trampoline, springboard higher. Does it do so? Absolutely. So I've taught you how to look at order blocks, how to qualify them. They got to be in a discount or a premium. The higher time frame ones, you need to transpose those levels to the lower time frame. And when you go into the lower time frame, you want them to be in agreement with at least 3 PD arrays, 3 more things to justify it. The level of a order block's opening price or mean threshold is in and of itself, by itself, useless. They are the markers in which you go into price and you study around that. And if you have 3 PD arrays, 3 reasons, whether it be liquidity or specific price levels that is a PD array. Liquidity is always a PD array, and it's dynamic. It can be in any time frame, any level of premium or discount. But when it's coupled with a level that is expected to promote higher prices, it's a slam dunk. Like, it's a slam dunk. There's nothing to consider about it. It's easy. It's just waiting for you to get in it. If you don't get in it, just take the next one, because they're going to repeat every week, every day, and it won't stop. That's our moniker here. It never changes. It just gets more precise. It gets more detailed, more confidence building, because we're not reinventing anything. We're not changing parameters. We're not moving the goalpost. We're not saying one PD array is growing in popularity, so therefore that's the better one. Any one of those PD arrays can be a catalyst. And that's why it's important for you to just pick one to warm up to first. But you're going to want to go into all of them eventually for you to get a well-rounded, comprehensive visual representation of what price is doing algorithmically. So here's what it looks like on the 15-minute chart. We'll just drop down for shits and giggles on the 5-minute chart. Excuse me. Last down close candle, displacement to the upside. Did we trade to consequent encroachment of that buy side and bell, sell side efficiency, and the upper opening price on the daily bullish order block, that level here? Yes. Did we see displacement? This candle? Yes. Last down close candle. What is the change in the state of delivery? What price is it? It's the opening price. What opening price is that? Look right up here. What opening price is it? 17,710 and a half. Price comes down, trades to the low of that candle. What's the low? 17,709.25. Did it respond? Did it respond? Did it prove there's a change in the state of delivery and algorithmically repriced higher? You're going to tell me that's buying and selling pressure? That's buyers came in there, right? Buyers did that, right? Yeah, I love it. I love it. I love reading people talk that bullshit, because that didn't happen. Okay, that did not happen. Price expanded higher. And then what do we have here? You missed this down here. You weren't able to dial in. No problem. We're on a 5-minute chart. We're in a 5-minute chart. We're still below equilibrium. So we're in what? We're in a discount. So can we take a fair value gap entry? Absolutely. Yes, we can, Virginia. So watch. Here is your fair value gap right there. See that? We're going to take this off because we've already highlighted the area to start looking for the setup. But right in here, where's the best entry, ICT? Can you just cut the bullshit and tell me how to buy a fair value gap appropriately? Tell me where to put a stop loss. Where's the best entry? How should I trade it? Okay, you listening? You're listening. Put the fucking Doritos down. Take your headphones off with your music while it's pumping behind me talking. Listen. This candle right there, okay? You want your entry to be in the upper portion, that price level or higher. You can save yourself a lot of heartache by just simply going in one tick below the high of it. Your risk is the low that creates the fair value gap candle. Determining how many contracts you can afford by whatever risk parameter you're using, While you're learning, use 1/2 of 1%. And that means you're probably going to be using micros. And guess what? That's not a problem. It's only a problem for short dick energy people. So if you look at this right here, that gives you your framework. What was the midpoint here? Or consequent encroachment? 17,770.25. It trades down and offers that price level plus its tick. The low is 17,768 3/4. Spread's not going to be a factor there for you. I never, listen to me, folks. This is a constant. I never use the consequent encroachment level as a limit order. I never do that. There was times when I tried to do that because I wanted to be really, really in there at the lowest low, and I wanted to be Mr. Ego, Kid Ego. Okay. I missed some really good trades, some phenomenal trades, like huge, huge runs, because I demanded that much precision. There's a balancing act here that you're going to have to manage, okay? If you don't get the lowest low and you're off by 2.5 handles and you're able to capture 100 handles or more, risking, not very much at all, are you going to lose sleep over that? Because if you are, you have some work to do. Your expectations are too high. The upper portion of an order block, from its midpoint to its high, every fair value gap from its midpoint to its high, if you're buying, that's your ideal entry. Is there anything wrong with trying to buy the midpoint between consequent encroachment and the high? No, that's usually that's a sweet spot where I like to do most of my buying. My largest portion entry will be in that vicinity. And then sometimes when it's still meandering around in here in the same candle, I might fancy dance and add a little bit more, because if I see something in a chat room, or if I see a lot of chatter about something that's opposed to what I'm in, I'm going to try to get on that same candle that's there, because I might not get an opportunity for it to come back and revisit this area again. But it's important to know that you don't have to be the perfect entry. I've wasted decades, folks. I'm going to be honest with you. I've wasted decades trying to do something that I've not been able to dial in on in perfect exits. But you don't need perfect exits to make money. The same side of the equation, you don't need perfect entries. They don't need to be perfect, but they have to be logical. They have to be in a capacity that allows you and affords you to manage the risk that's associated with that setup. And if you discount the necessity to manage the risk and only try to look for the largest position size that you can place on every trade you enter, you're doing it wrong. You're doing it wrong. You're going to be inflicting more needless scar tissue that will never go away because you're trying to do things your way. Your way, in ignorance. You think that you're going to come out here and do it better than somebody else that has proven, with other people listening to them, bringing home the receipts of that. You're going to be the head of the class. You're going to be teacher's pet. You're going to do it your way mentality. I've had so many students come to me and try that approach in tearful emails and voicemails and sending me face-to-face videos where they're literally telling me, like, this is what I've done. How can I fix this problem? I've done this, I've done that. And I said, go back and listen. And they put down all their other reasons why they're trying to do it. They put down, I'm trying to look good in the eyes of social media. I'm trying to just focus on making money. I'm not trying to impress my ex-girlfriend. I'm not trying to impress my anybody. They're trying to get good at it for the sake of being good at it, because the default to that is you're profitable. How profitable will you be? That's determined upon how much you can manage money. And that's a lesson outside the scope of all this, because it's reasonable to assume that, if you do the right things and you're not over leveraging, you should be profitable. Should is not a guarantee, but you have to have a framework. You have to have a foundation to build upon before you can reasonably expect that is going to be the outcome for you. And if you're not willing to subject yourself to the process of going through this, looking for it in hindsight. That's how I did it. I went back and I found them and I said, okay, these things tend to happen all the time when this occurs. When these confluence of events occur at this time, go back and look at the examples. What time is it happening? What candle time is it on right now? Hard not to grin, isn't it? There ain't no fucking macros. No, there ain't. Let them believe it. When they say it, let them believe it. Don't try to convince them otherwise. Let them stay in fucking ignorance. Let them stay there. They chose it. They ain't done the due diligence to go back and see and prove it to themselves. Let them stay stupid. Let them stay stupid. You can't fix stupid. I've had a lot of students come to me with a case of the ass and they knew how to be taught. You need to teach me. Get the fuck out of here. Get out of here. I ain't got time for you. Goodbye. Banned. Goodbye. If you're not willing to listen, because all the evidence is here. You can see it working. You've got students all around the world proving it. What's keeping you? Your elevated expectations and trying to live up to them. And you're doing it all wrong. It needs to be boring. It needs to not keep you up at night. If you're worried about this shit in bed before you go to sleep, your expectations are too high. They're too high. You're placing too much pressure on yourself. Relax. This stuff is not hiding from you anymore. They cannot hide it from you. They cannot hide this from you. Okay? It's always going to be there. As long as these markets are trading, these things are always going to be there. Why? Because people are greedy. They're going to buy and they're going to sell. And when they put a stop loss in there, it's waiting to be fleeced. Nobody's going to turn the industry upside down and say, here's how you trade properly and never need to use a stop loss. That's not going to happen. There's a lot of people try to do that on YouTube. They try to sell that idea on Instagram, maybe on Twitter. But that shit don't hold water. That dog won't hunt. So you need to stop worrying about, they're going to change that. They're not going to change shit. There's a new line of suckers coming in trying to use John Murphy's bullshit. Okay? There's always new people coming here all the time trying to trade support resistance and moving average crossovers. There's a whole cult and religion around zoo patterns. Harmonic horseshit. That stuff doesn't have any bearing on why price is going to do what it's doing. Nothing. It has nothing. It's just, that's a convenient anomaly. That's all it is. Because large institutions are not basing their they're not basing their trades with billions of dollars on the basis of a fucking harmonic cactus pattern that, some goober draw some kind of a emblem or whatever on a chart and says this is what it is. That's a gimmick. The market goes high for inefficiency or stops. The market goes down for inefficiencies or stops. Prolonged moves just goes for further out liquidity or inefficiencies. It's not buying and selling pressure, period. It's controlled. Absolutely 100% all the time, 100% manipulated, controlled, and delivered based on what they want to happen. That's how it is. That's all it is. It's a big casino, and all you have to do is walk the aisles. Walk the aisles and wait for street money to get off those slot machines that ain't paid out to them. Because they can't see the opportunity. They can't see the opportunity that they've created by leaving, by being on the other side of the trade. The other side of the trade where they think that this isn't going to go up for me. It ain't going to pay me out. So I'm going to leave it. I'm going to go chase another setup, another pattern, another machine, another approach to trading. And right when they are diametrically opposed to when you want to be entering a trade, you sit down, you put your money in the trade, you pull the arm down, and you wait for it to deliver the 777 jackpot. And when it pays you, you get the fuck off that machine and leave, and you wait for another day, another opportunity. Not, wow, I just got this jackpot. I'm going to put some more money in this same machine, expected to do. That's what you did when you won money in your account and you trade, and you wasn't satisfied with it. You go in and you turn that winning day into a losing day. How many times have you seen people do that? How many times have you done that? Could it have been avoided? Yes. When you make money, stop. Stop. But you could make more. Yes, you could. And you can make more of an ass out of yourself by giving away a profitable day. And it happens every single day. So there's a long line of suckers coming in here every single day. New money, new street money, same logic. I'm going to get real rich real easy because Instagram boys told me. Anyway, I'm having a lot of fun with this, I'm going to be honest with you. So we have a gap here. What time of day is that? New week opening gap. Okay. New week opening gap. That gap many times will be retraded to, not just once, multiple times. Multiple times in the course of a week. Every single time you see an opening gap like that, I don't care if it's one tick, that's always in my analysis. Oh, come on. I'm telling you right now, it's just that simple. That opening gap will be referred to all week long when price is in close proximity to it. Many times it can act as a target for a trade. Many times it'll act as an entry, and or it can be it can act as a buffer for a level for where your stop needs to be above or below, because it can reprice to it all week long. And if you start putting a stop loss right at that same general area, you're asking for it to be hit. Yeah. And the same thing with a new day opening gap. End dog. If you place your stop loss on any trade inside a new day opening gap or a new week opening gap, you're basically saying, here's my ass, back up into it. Don't lube it. You're asking for it. You're begging them to do that to you. Until you learned about it, you never would have understood that principle, but that's what's going on. You don't want to place a stop loss in a level that is more prone to be revisited. You don't want to do that. There are times when an order block or a fair value gap will fill in that entire range. It doesn't mean it's a bad trade. It doesn't mean that it's not going to run for you. But when it does completely close in its range or completely trade all the way to the bottom of the body of the candlestick that makes it the order block, then you must demand superior price delivery, where it's got to be explosive. Like it's got to be off the rails volatility, straight one direction, one line, straight win, right to profit. No dilly-dallying around, no consolidation, no bull flagging, none of that stuff. It needs to be absolutely like a bullet taking off right to the target. Because if you don't treat it like that and you don't take partials, it's gonna turn into a losing trade. It's simple, isn't it? It's hard waiting for it. It's hard managing it and thinking about all these things while you're in a trade. Now think about how hard and complex you think it is right now, and then I got to type all this stuff out while I'm doing a trade on a 1 minute chart or a 30-second chart or a 15-second chart. That proves visibility. That proves that, number one, I can convey the idea on Twitter, either typing it out or talking it audibly in a Twitter space, referring to every one individual 1 minute candle. If there wasn't a logic behind it, I wouldn't be able to do that. But because there is a logic behind it, because there is a reason for it, it can be repeated. And that means you can learn how to do it. And you won't need to come back to my YouTube channel. You won't need to worry about what I'm doing. How did you trade today? How did you do this? And what market did you trade? You won't care. You won't need that outside confirmation or encouragement. Your results will be encouraging enough. And that was a very hard thing for me to learn, where I had to find the approval. As a young boy, I always sought that because my parents, the whole show I gave you before, they didn't want me. So I had to always seek approval outwardly. And the results that you find in doing the right thing controlling your method of managing the money and the risk, and then seeing how it delivers and pans out, and you grow as a trader and your understanding and your results. That is what you'll get the attaboy, attagirl for. That's the approval that you're really seeking, and being content with that, not needing to have outward confirmation that you're a really good trader, or you're a really good tape reader, or you're a really profitable trader, or you're better than that trader and that trader. Look, all of that isn't going to help you pay your bills. It isn't going to change your legacy wealth. It's a distraction. And what that's doing is it's appeasing the discomfort that you're feeling while you're learning to get to the point where you're bored with your results because you know what you're doing works. Doesn't mean you're going to be profitable every time you take a trade, but by far and large, your monthly results should be net gain. Your yearly results should be net gain. And having any conclusion about how it should be better, it would have been better if you do that, you're creating scar tissue. Don't do it. Don't compare yourself to me. Don't compare yourself to other traders. Don't allow yourself to be compared to by anyone else. Don't do it. You don't owe these people anything. Social media has a funny way of making you feel like you're obligated to do this stuff. Bullshit. You don't need to know what I'm doing. You don't need to know what anybody else is doing. But the ones that are willing to share it, they should be respected, because not everybody's willing to do that. And it takes I had a lady student of mine. She just mentioned that she's entertained the idea of live streaming, and I immediately said, don't do it. And thankfully, I had other students came behind and supported that idea, because if you're finding profitability now, and you feel the inclination and you want to go out and prove it to other people, because them telling you that you're doing it good, that's what you need, then you haven't done it enough to be bored with the results to know that what you're doing works. So stay right in the position where you're at right now, which I'm going to roll and circle right back to Matt Miller. Matt, if you're listening, I'm telling you, don't change anything. Don't increase frequency. Don't increase leverage. Don't change anything. If you're going to do something different, do it outside the accounts that you're doing what you're doing in now. Don't do anything differently, and you will have a banner year, a blockbuster year. And it needs to be boring. It needs to be boring. Just like a fucking job. It's the same mundane bullshit. You know, when you put the time in, you're going to get the same paycheck every week. It's going to be the same thing. You're not going to be surprised. You're not going to be like, what the hell happened? I didn't get all the money I was supposed to get. If there's a problem, you go to HR and fix it. But here, you are HR. You are the CEO. You are the boss. You're the captain of the ship. And you've said it audibly, you're fighting the impulse to do more. And you're reading comments, and the audience is telling you to do this and do that. Fuck them. Fuck them. They're not doing it. You are. You're assuming the risk. You're doing all the heavy lifting, but you're going to listen to other people give you advice. These people on social media are fucking wild. They have no idea what they're doing, but they're trying to advise other people. Get the fuck out of here. So my advice, sincerely, in closing, don't do more than what's necessary. Think about it, man. $160,000 in 2 months, or the equivalent of. You're killing it. You're killing it. And you had losing days and it didn't even bother you. And you live streamed it on top of everything else. That demands and commands respect. And you got mine. You got it. So don't change it. You have exactly what everybody else would cut their left arm off for. And you're walking it in front of everybody. And that's good. And you're not doing it with an ego. That's beautiful. You're not talking down about any other trader. Fucking beautiful. That's how this industry should be. That's how it should be. Not some drama bullshit trying to get some kind of clicks because you can't trade profitably and you got to delete your fucking streams. No deleted streams. Let everything as it is. When you have a losing trade, you leave it up. That's awesome. You don't make excuses for it. You own it. That's exactly how it's supposed to be. That's exactly how it is when you're really trading and you are by yourself. And I love it because I've watched a lot of people troll you and they ain't coming close to what you're doing. And that to me is fucking poetry. I love that. I love it, and I don't need to name them. They know who the fuck they are. Believe me, their fucking asses puckering right now because they were. Oh, please don't say my name. We all know who you are. Broke, broke ass motherfuckers. Well done, Matt. Well done. I will be here tomorrow. It'll be more specific with candlesticks, and we'll watch some stuff live. But I have shared where I believe the Monday, Tuesday, Wednesday draw on dollar is. I believe that all those things panning out, barring any event that would be inspired by a Middle East type thing, I'm confident that that's okay for my analysis, my approach to seeing things. But we got a couple seconds. Let me go over 5 minutes. Okay, I'll go over 5 minutes because I just want to take a look at the lower time frame. 1 minute. Always doing more. Yep. All right, so we had this parabolic drop this morning. Low, lower low. Rallied. What is this? What's that right there? Fair value gap. Buy side imbalance, sell side inefficiency because it's an up close candle. Ideally, what do you want to see? You want to see a piece left open. Did it fully close in that? No. Where did it trade to? The lower quadrant. You see that? Right there? Where's the bodies? See that? And then once it did that, what does it reach for? Premium. Premium relative to what? You have this range here, and then you have the larger range there. See that? I'm not going to refer back to this here because we've already had what happened. Well, that's your range of the day. Did we go above equilibrium? Yes, multiple times in closing basis. So you can't use that range now for defining short-term premium to discount. This low did not take that low out, but we had market trade higher. So we have to look at a shorter time frame range, which is inside the larger range of the day. So from this low to that high, above this level, we have to look for inefficiencies when we're retracing. Is there inefficiency in here? No. And then you have the short-term high, and you have this high here. Any inefficiencies over here? Not on this time frame. So that's using this range here. If you're using the even smaller time frame, shorter term range here, this is all trading inside the range, needing not to see it trade outside the range. It rallies here, your fair value gap there. See that? Where did I tell you the ideal entries are going to be at if you're trading fair value gaps or bullish order blocks that are buys or bullish? It's going to be in the upper half. So there's your fair value gap. There's the high of it. Here's consequent encroachment. Oh, hot damn, look at that. Just seems to keep happening over and over and over again. And they'll tell you that's buying pressure. It's buying pressure. Oh, I'm feeling the pressure. So we have relative equal highs here. And then we have this wick. See how we've already worked consequent encroachment that multiple times in here? Because it's done that and it's rallying, I would want to see that buy side above the wicks high now, and then maybe revisit this inefficiency because it left a small little piece open right there. I'll draw that out. It's a rectangle. So for PM session consideration, if we continue to press higher, just look for it to trade into that. And then we have this inefficiency over here that was left open. And we'll do this. See how we went to consequent encroachment, that inefficiency there? Overshot a little bit, but look at the bodies. Then we had a breakdown. Shift in market structure. This model 2022. Where's the sell side? There. That's what it hit. Over here, Tuesday and Wednesday, we're going to do this stuff live where I'm pointing out things as we look at
price as it's panning out, if I'm going to have it on a 5-minute, 1 minute, and a 30 or 15-second chart. So you'll watch everything live, and you'll see how everything agrees and supports or negates the idea of continuation higher or lower to a premium or a discount. But I wanted to introduce just the basics. This is like a real basic. It may not feel basic for some of you. Probably feel like, man, this is way too much, and you went over my head with a lot of things. And that's simply because you probably haven't been a student of mine for a while. But I promise you, the folks that's been with me for a while, they know what my PD arrays are. They know discounted premium. They know what an order block is, and they've struggled with when do you buy a certain order block, and how do you treat an order block, and what's the entry price, and what's your stop loss. I get so many questions for, like, where do you place your stop loss at? If I'm trading with a fair value gap, I'm putting it below the candle or above the candle relative to, if I'm buying or selling, the candle that creates the gap. That's what I'm doing. If I get stopped out and it trades back below or above respective to the fair value gap, in deference to it being a bullish or bearish PD array, I'll treat it as it needs to move out of it and then come back and retest it. And then if it does, then I'll enter there and I'll put the same stop loss I used initially. It'll be many times a little bit larger in terms of risk, but I've already reduced my risk generally, not all the time, but usually in the case of that type of setup, I'll reduce the size or leverage because I've incurred a loss. So I think that's going to be it for the first one today. I covered a lot of things that, in my journals, I went back and looked at my first 3 years and the things that I complained about. I addressed and tackled those big sticking points that I had initially. Now, obviously, there's a whole lot more things I'm going to cover and things that I'm going to use that have been presented to me by my own students, both paid mentorship students that I don't operate a paid mentorship anymore. Stop asking, because obviously you see I'm doing this for free now. I don't create content that is video or audible for paid students. We basically just hang out. Once in a while, I'll call the market with them. But whenever I get a student that talks out their ass and say, you don't make enough content for me, then I stop doing it for a week to let them realize the benefit they have of having contact with me still. But looking for setups like something like this one here, okay? If you were to take that long and only use the low of that candlestick right there, okay, your entry would be 864 and a quarter. So 864 and a quarter. If you were only going to use a simple bread and butter approach to just trying to make money, you're not out here trying to impress everybody with the full daily range. You're not trying to be ICT Junior or 2.0. You're not trying to be, Omni-Man of fucking trading. You're literally just trying to get money and get done and move to the sidelines and go live your life. You could use this pattern here, and the range that it is retraced from, that's this high right here. Be honest, okay? If you were able to find setups like this on a daily basis, buying inside of a fair value gap, the easiest sure thing entry, which is the only one that I think you should be worrying about right now, one tick below the candle that creates the highest parameter for the fair value gap. Because if this is the fair value gap, let me zoom in just to be more friendly in the eyes. Can you tell I love doing this? If my wife was here, I wouldn't be able to do this, but we made some arrangements. This candle here, okay, this is the fair value gap between this candle's high and that candle's low. This frames where your stop loss is. So your stop loss has to be at the body or the low. Depends on what you're willing to assume in terms of risk. If you want to be really aggressive about risk, you're doing trade with a larger leverage, then you're going to obviously go with the body. If you're more risk averse and you're not going to trade with large leverage and you're learning still and you want to give yourself some flexibility to stay in the trade and not be potentially stopped out, you're going to use the low of that candlestick. And somebody already doing the math on it, saying, well, this is a little bit too much of a stop loss for me because I usually trade with 3/4 of a point of a stop loss, and I'm trading with 15 contracts in a funded account, which is in a real account because it's not really going to the markets. Therefore, they're not going to tag your liquidity, and you think you're a rock star. That doesn't hold water, okay? you need to manage the risk appropriately and not try to squeeze every possible outcome that's the best case scenario for you. You need to be looking at how can this hurt me? Every trade should be, how can I make money, but reduce it to the minimum amount of money that I could go to sleep knowing that I lost it and nothing's going to change the way I trade. To me, that's the definitive answer that I had to assume for myself. Not what could I afford? Because what you think you can afford before you trade on ain't really what you can fucking afford when you take that loss. Because any loss sucks, especially for a man. Any loss sucks. A break-even stop out fucking sucks. It sucks. We hate it, especially if it starts to run off. But mature, personally responsible traders have to do their due diligence and determine how much can I lose today. And if I lose that, I'm not going to feel any apprehension at all doing the same model, same trade the next time it forms. And be honest, how many times have you done that? Probably never. And until I started holding my feet to the flame with that perspective, I couldn't stay in a trade or take the next trade. I would always get scared to take the next one. I'm 20 years old. Nobody's coaching me like I'm coaching you. Nobody encouraged me and gave you these rants and stuff. It's just I had to go through it. And I quit dozens of times. But quitting, if you're a trader, is just meaning you're taking a break or you're trying to save up money, put more money in an account. That's really what it means. But if you can't stay away from this stuff, you are a trader. So you might as well just start learning how to do it right. But the entry would be one tick below that. That's the easiest, no-brainer. This is how you do it. The stop loss is the low. Or if you are using larger leverage and your convictions are strong, you can use the body's low. In this case, it would be opening price. So the difference is whatever that is. How many contracts can you trade? I don't know what you're trading with in terms of equity, but you should be trading the least leverage that you can possibly do. That's a micro. A micro, okay? You're not risking a whole lot of anything, but you're learning. And then you just target the buy side here. So if you're trading 864, we'll just say you got filled at 864 even. Okay, 864 even, and you're getting out at 885 and a half, one tick above the high. Like, are you capable of finding 20 handles every single day right now? Probably not. But these types of formations happen every single day. And this is just a 1 minute chart. What happens if you take that and you get out and you took that 20 handles and you're done? Then you come back in later in the day, but it went up 500 handles. Are you going to kick the dog? Are you going to take it out on your spouse? Oh, don't talk to me, man. I had a trade. I could have paid off this part for my car. I could have done this. I could have done that. If you do that, you're living in the rearview mirror. And it's always easy to find regret. It's always easy to beat yourself up about that. And that's not building you up. It's tearing yourself down. You made 20 fucking handles. That's more than Retail Rick with his harmonic horse shit. You made money. You banked it. You treated it like a business. Every business that operates isn't trying to get every potential fucking sale. They know it's not realistic. They do what they can within their means to try to get the people to spend the money, but they're not going to break their business trying to do it. And traders many times do that very thing. They do more that's necessary and aren't profitable as a result, and they keep doing that same thing thinking it's eventually going to crack and they'll be wildly profitable when they could just do exactly what I've preached. Find a low-hanging fruit objective. You're not trying to trade the whole daily range. You're not trying to pick the low of the day. You're not trying to pick the high of the day. You're not trying to get 100 handles every trade. You're looking for something that's going to be easy. Go in, get it, be content with that, be happy with it. Fuck off if your opinion about that is you should have did more. Who cares? They shouldn't know what you made on your trades. Nobody should know that. Nobody should know that. That's your personal business. Why the hell are you letting somebody else run your business? Then you wonder why your shit ain't working right. Because you're letting everybody else come in and run it the way they want it ran. Yeah. I think that'll be it for today. I'm hungry. I'm fasted. My stomach's talking to me. I need to eat something, and I'm parched. So I do really want to sit here until that yellow box is hit, to be honest with you. If I was at the exchange, I would sink it though and say, fuck ICT. I'm going to drop this bitch 80 handles. Fuck you and your live stream. Come on, Pat, do it. But tomorrow, we've done all the preamble talk. Okay, we're going to go right into the charts, and we're going to focus primarily on ES and S&P after the 9:30. I'm going to look at Forex pairs, Euro dollar and cable tomorrow from 8 o'clock to 9:15. So 8 o'clock to 9:15, our focus will be on Forex. And then at 9:30, we'll transition into focusing on the futures markets and until around noontime, and then we'll break again. But obviously, there's a lot of things I still want to cover, and we have it, and I'm on schedule. It may not feel like I'm probably stuck to a schedule, but I completed everything I wanted to cover today. That's why I started cutting up a little bit. I did a fair enough job to beat my outline. So in that regard, I'm okay. But tomorrow, we won't have a whole lot of like explaining this, explaining that without looking at charts. Everything is going to be over price action from now on. So tomorrow and Wednesday will be literally immersion in price action live, explaining what it should do, what it shouldn't do, why it's useful, what would be problematic if it does one thing or another. All those things are actionable things. They're things that can be used in the future. That way you can learn from it, repeat it, apply it to what it is that you're studying. So the buy side, remember I was telling you over here, that wick and how we already went to consequent encroachment of that wick multiple times. That means we have to cancel that as a draw. It can't act as a draw anymore. It's not something we would favor. It's the high of that candle. That would be the one that would be the buy side. That would be the draw. Use the DVR setting I have on my. I don't have it turned off so that nobody can rewind it and take a sound clip out of it and put it on YouTube and say, no, you didn't say that. I'm saying everything in front of you. Not worried about what the outcome is going to be. So you can see how we ran up in there and engaged that liquidity. So if it's going to move up above that, how far can it go? That's a question I get all the time. Like if you're looking for a high to be traded to, how far can it go? How can you trust when I do turtle soups, when I try to sell old highs being broke and pierced, and I sell short as it's running through them? They're going to be instances where like it's an obvious PD array above a buy side that I trust is the final definitive target that they're aiming for repricing it to a deep premium before sending it to a discount. In that case, or in this case here, the buy side resting above that wick, just above it, how far can it go? Well, then you have this inefficiency. We've already traded to it, but see the difference between the high? Look at the high right there. That's this price up here. The high of that candlestick is 17,908.50. And in the low of that candle over here is one tick. That's enough for the market to want to reprice up there because it's a separation. It's a separation between this candle's low and this candle's high. So it's a SIBI there, sell side imbalance, buy side inefficiency. So how far can I and what I measure if it's going to go above it on high? It's this entire range. It doesn't need to do that, but that's what you aim for, and you trade it accordingly. So if you were long, say you took off, say you had two contracts, and you went long down here. You take one off here, and you let it run. The target was explained to you over here. That's the buy side, and then you want to sit back and wait for it to engage that. Then you have a choice. You either take it off on a limit at that level, or hold it and manage a stop loss to see if it can dig up into here and maybe even run off even higher. That's the purpose and the luxury of having a runner. You have the luxury of determining what you want to do with it. Do you want to cut it off at a definitive level? Well, I gave you that. It's right above here. If you want to let it run, if it gets to that point, how can you manage that? You use it as a trailing stop loss. Trailing stop losses prior to areas where a partial would be logical. If you're trading any position with a trailed stop loss and you're moving it up into a range from a discount and then you're entering the realm of what would be premium, and I'll explain that to you right now. In this example, you would have this. That high to that low is what we measured, and we would be in a discount still trading to this fair value gap, which is the first one that formed because there's no fair value gap in any of these up close candles. The market trades down into that fair value gap. That's your first entry that you can now target premium. Premium is defined by the high to low of that range. So midpoint of that, let me just pop it up real quick. It's a long 5 minutes, isn't it? That's how I roll, baby. That's how I roll. You always get more than you paid for. That's equilibrium. So minimum is to trade to that, but it does that, and then it comes back to that fair value gap. So now we're in a discount because here's equilibrium to the low. Discount. Then it's going to do what? It's going to expand up into a premium. So what premium arrays do we have? This high, relative equal highs, that wick I talked about, and I said that high. How far can it go above that? It can go up into this old range and bump that last up close candle. You either take it off there on a hard line limit to say, okay, my final runner, we're just going to call it a day there and be content with it. Or how would you manage the stop loss? Your stop loss cannot enter above this region here because you're entering into a realm where it can retrace still. So your stop loss has to be, oh, this will be a good place here. So whatever it was here, it's trailed up to there. If you look at my trades, that's how I'm managing them. Unless I'm real close to terminus and I have one contract left, then I'll trail it up to something that would be below here because there's a fair value gap and we already traded to it. So I wouldn't want to see that fair value gap traded to and go over, or below it rather. It would be failed. Okay, so it's a matter of context, where you are in the trade relative to where you were targeting, and the runner is where you want to finesse. The last little piece of your profitable trade, that's the one that you have the luxury to finesse. Whether you get stopped out on it, whether it goes to a hardline limit order and you exit out there, or you hold on to it and you keep your stop loss at break even plus commissions and costs and just let it rip and go see what happens. None of those outcomes are wrong. Because if you take it off at any time and it runs 200 handles, and if you would have stayed in it with that runner, you're going to consider that wrong. You're going to beat yourself up out of it. So you got to give yourself permission that any outcome on a runner in a profitable trade after you've banked partials, there's nothing wrong with anything that you do with it. There's nothing wrong with that. And that's managing your expectations. It's also managing your ability to stay within the context of a bias, whether it be the daily bias or the session bias. Yeah, I'm going to be content with this for today. All right, so I hope you had fun today. I hope you learned something. I covered a lot of stuff that were very important factors for me when I was coming up as a trader at 20 years old. And for me, if I would have had these things submitted to me as study points, things to reference and consider when I'm trading and developing, I could have shaved off years and certainly probably wouldn't have blown so many accounts as a 20-year-old. I would have probably done a whole lot better sooner because it would have given me processes, rules, what to do, when not to do it. And we're only starting. This is only the beginning. There's a whole lot of content still that we're going to cover between now and Wednesday. But for the first day, I think I've covered enough, and I've given a really good foundation to everything that will be referred to in technical terms over live price action. So have yourself a very pleasant day. Hopefully you enjoyed it. If you did and you appreciated me spending my time with you, give it a thumbs up. It doesn't cost you anything. I promise it doesn't make me any more ad revenue. It's just a way for you to kind of as applause. Okay, if you get something out of it, that's what I'm looking for. If you don't put a thumbs up, I won't know. I don't really give 2 fucks. I don't care. It ain't gonna change the way I live. It ain't gonna change what I eat. It ain't gonna change how I sleep. But it's just a way for you to give me feedback. Okay, so that's your way of saying I got something out of this, and that's how I'll look at it. And I'll talk with you all tomorrow at 8 o'clock, Lord willing. Until then, be safe.